All right. Yo, what's up for y'all watching this on the YouTube replay? Hope you're having a great Sunday. We're going to be live at 8 p.m. Eastern time tonight, so in like 8.5 hours as well. But check this out. Let me give you a quick portfolio update and a little bit of update on the market because the Feds just cut interest rates by 25 basis points. So if you look at the middle of my screen, whenever Feds cut interest rates, the interest rates on your high yield savings account, the interest rate on your, money market funds all drop as well. So usually what happens is people in a lot of cash that have money in these, high yield APYs are slowly, as rates slowly go lower, are going to slowly move that into stocks and potentially, dividend stocks or growth stocks. So I think a cool alternative now to a money market fund, because remember, a money market fund, your APY high yield savings account, whenever you receive money like that 3.35% APY is actually taxed at short-term capital gains and not long-term capital gains. So here's like an interesting alternative, I think. This is ticker symbol SO, Southern Company. You get a higher yield. You get a 3.5% dividend yield, but it's a qualified dividend. So for me, that's actually taxed at 0%. So all the income I receive from Southern Company is taxed at 0% for me because it's a long-term capital gains, and since I make under 50K a year, long-term capital gains is taxed at 0% for me. But check this out right here. I'll show you how sustainable this company's dividend is. It has a 3.51% dividend, and it also keeps up in stock price appreciation. It does really good. So yeah, hey, what up, Plasma? Yo, what was that stock you commented on the last stream? Let's actually check that one out. But yeah, check this out right here. Here's Southern Company. I want to show you how safe that 3.5% dividend is. They made 1.71 billion in net income just this quarter, and we can see the cost of the dividend is actually. Oh wait, we gotta go over here real quick to find that. Okay, the cost of the dividend is 760 million a quarter. So a very safe payout ratio around like a 60%. That's actually normal for these regulated utilities. They own a bunch of regulated utilities like I love, like Georgia Power and Light, Alabama Power and Light, some gas companies as well. So they're just a behemoth, the third largest utility company out there with the high yield. So yeah, also I made a new watch list right here. I called it Good High Yielders. So these are all stocks with around a 2 to 3% dividend that have very safe 2 to 3% dividend yields and should also do good in stock price appreciation. So if I was wanting, and I don't have this as my current portfolio because I don't want all high yielding dividend stocks right now. I'm trying to maximize growth and go in these mostly growth companies. But if you're looking for some higher yielding names, like 2 to 3% yields, these are a lot of good names, I think, like literally all these. So I made a specific watch list for that. But yeah, let me give you a quick portfolio update. This is actually my dividend only portfolio where every stock in here pays a dividend. And but most of these, as you'll probably see, are like dividend growth companies. And here's our total percent change on every stock. Luckily, we're green on every single stock in here, except Carlyle Group. We're just barely down on that name because they're pretty interest rate sensitive. But yeah, that's our dividend only portfolio. We're up 15% year to date. I think I'm underperforming the S&P. What are they doing? S&P is up 15.69%. Actually, we're doing right nearly, we're 0.10% like lower. So we're almost doing just as good as the market. We also have a Roth IRA. A Roth IRA is just a tax-free retirement account. And these are all the stocks that we own in here. I got Webull. Hey, we're actually up on every stock in here now. No way. So yeah, Cavco is our newest holding. HCA Healthcare is, I think, a good stock. So yeah, then we have our Moomoo portfolio right here. It's known as our never sell portfolio, where once we buy a stock in here, I just never sell it. I diamond hand it. That's the reason we're doing so good, is because we didn't sell these stocks before today. I can't say the same for my other portfolios because my biggest regrets in there are actually trimming and selling out of great companies. But not in this portfolio. We don't allow myself to, we diamond hand in that portfolio. And then we have our Webull account, of course, where we haven't done too great. I mean, we're up 19.5% all time in here. I just love being fully transparent. I'll share with you my entire portfolio, my best performers, my worst performers, and all that. So yeah, here are all the stocks I own in here. Like Robinhood, that's a great example of one I super regret selling every share I've ever sold of them. I made like 300% on them, and I trimmed it there, most of my shares, and that was the dumbest thing I could have done because it's up way more now. And same with like SoFi as well. I barely got any more shares of them left. But yeah, we also have some losers and some hidden losers like ChargePoint. We lost a lot on them. So how do you get around taxes you get from dividends? Well, you could hold your dividends in actually a Roth IRA, but there is no way around it. But for me, actually, here's a cool little thing. Like every stock in here, for example, all these stocks pay qualified dividends. So whenever me, for my tax bracket, and I'm the tax bracket's like 53 or 54,000. If you make under $54,000 a year, which is me, your long-term capital gains, aka your dividends, your qualified dividends, are taxed at literally 0%. That's why it's more attractive. That's what we were kind of talking about at the beginning of the stream here. That's more attractive to potentially buy like a 3.5% yielding utility company, because they just cut money market funds. But look at this, you only get a 3.35% APY on your cash now, as Fed just lowered interest rates. And it's not just, it's all the high yield savings account, all the money market funds. So it's potentially more attractive to put that into stocks. Hey, what up, Plasma? Yeah, we'll get to American Semiconductor too. Now, there are some dividend stocks that don't have super sustainable dividend yields, but actually Target's one that actually has a pretty high yield, and it does look pretty safe. And I'll show you how to tell if it's safe right here. So if you look at Target right here, check out this yield. You get 4.63% of your money back every year. It says the payout ratio is a 50%, but let's go do our own little payout ratio. And I'll also go over why Target's struggling compared to Walmart. You won't believe this. You normally think if Walmart's doing good, you'd think Target's doing good. But look at Walmart. I mean, it's nothing short of just borderline impressive. But Target is being hurt more because they sell more discretionary items than like grocery stores. I used to actually break it down. Let me pull this up right here. Yeah, look at this. So like food and beverage is only 25% of the revenue. Household essentials, apparel, home furnishing, beauty products, a lot more discretionary items. And they kind of lost the growth on that. And they're kind of just being out innovated. I'm pretty sure most things you can get on Target, you can get on Amazon and Walmart. But yeah, so if we look at the sales, the revenue, the lifeblood of the company, it's actually down 1.5% year over year. Not great, but here's the net income. This is the really unfortunate part. They only netted $690 million in net income. And they've had, it's negative comps. They used to make, but on average, let's just say they're making 700 or 900 million of net income a quarter. Check this out. If we go to see how much their dividend cost exactly, it cost exactly 518 million. So yeah, they really can't afford the dividend every single quarter. I think the stock is just struggling because their margins are going down, the revenue's going down, the net income's going down, 2.7% net margin in the most recent quarter. So Target might be fairly valued around this 12 PE, which is kind of sad to say. But it does look like the dividend's safe. Hey, try not to spam there. I don't know what that is, Warrior. If you got a stock, give me the ticker symbol and we'll check it out for you. But let's look at American Superconductor. Yeah, I thought it was semiconductor, but no. This is actually a pretty cool name. Good to see you, Plasma. And Eric, how's it going? So this company has a current valuation, a current PE ratio of an 83. Pretty expensive. But if we look at their next year out multiple, they trade at 58 times next year's net income, which is still expensive. But let's go see what's the market cap. Okay, so this whole company is worth $1.48 billion. So they're like probably in electrification. So grid, wow. Look at these year-over-year growth rates. That's very impressive. It's up 15% year-over-year. After grew 64. After grew 11. So they're on a streak of growth there. Same, let's check out the wind business. I don't know how. Wow, the wind business is doing great. That's up 53, after grew 38, after grew 157. So looks like this quarter they did slightly miss on revenue growth, which when they reported earnings, that's the day they gapped down dramatically. So they missed slightly on the revenue, which for a high PE stock, they probably deserve to. It might still be slightly expensive here. Let's see. So this is great news. They're making net income every single quarter. And actually looks like they had a little one-time adjustment. The real operating profit, the business grew 50% year over year. So the net income didn't actually fall 2% year over year. So everything here, 20% revenue growth. The revenue growth is slightly slowing and it did miss expectations, but at least this is great. They're making that income every quarter, and at this growth rate, what's it going to be this same time next year in a very good balance sheet? The whole company is worth $1.4 billion. Looks like they got $212 million of cash. Do they have any debt? Did they issue debt to get that cash? Let's see. No long-term debt. And yeah, no capital lease obligations. Or did they issue shares to do that? Okay, so they did. It looks like they diluted you by $125 million, but they've fortified their balance sheet. They're in a great position. It just might be a slight bit expensive. We'll see how the 59 forward PE, a slight bit expensive still. I do like them. Hey, MC Millie said, Rivian. I made a play on Rivian. Yo, that's great news. Sadly, did I just unplug my mic? I really hope not. Okay, no, I don't think I did. So Rivian right here, this is a stock they actually just released like their own chip. Like I kid you not, like their own like TPU, I think it was. Let me actually go check out the AI news down here. Rivian highlights LiDAR integration in autonomous driving plans. I'm Yeah, look at this. Rivian unveils AI chip in level 4 autonomy plans. Is that where all their money's going to right now? Because if we this is the one reason I can't buy Rivian. And I love their cars and everything, but look at this. They're losing a lot of money. And if we kind of just think about this, like look at their current market cap, the whole company is worth $22 billion. The whole company's worth $22 billion, and they lose, wow, a billion this quarter, a billion last quarter, 500 mil, 700 mil. Kind of just for all of eternity, this company loses billions. It does not. Let's say Rivian does it. I love their partnership with Amazon. So Amazon's the largest shareholder. Let me mention that. And I'm a huge shareholder of Amazon. Amazon owns 13% of all the shares. Porsche owns 12. Like when they get like they're selling electric vehicles, that's not too high of a margin business anyway. If we look at Tesla's net margin, I just don't love this name, but the end goal is to be like fully acquired by Amazon. Let's see, they have an automotive and a software as a service. Look at their software revenue. Wow, 300% year-over-year growth. I bet that's higher margin. We want to see their losses narrow, and the sales growth is good, up 78%. I guess after it fell 35, but. Anywho, Rivian, I would not diamond hand this stock just because the numbers do scare me a bit. Vehicles delivered 13.2K. But let's see, does they have like any results? Automotive segment showed improved gross losses narrowing. Software as a service boosted by the Volkswagen joint venture. Okay, so anywho, I know they are getting some like tax credits from certain states like Georgia. They released a chip and it dumped, so I doubled down on calls, made 3,400. No way. Hey, what up, Isaiah? Good to see you, man. Is CoreWeave a buy now after the dip? If I was going to buy any of the dip from AI, I wouldn't pick the data centers. I would not buy, honestly. Well, CoreWeave's a fun swing trade, like for the next year. Those are like the ones that are going to get hit the hardest, and they're kind of the ones that are holding the bag in the long run with these chips. So I recommend. Well, I wouldn't. CoreWeave, but it's CoreWeave's going to do good. It's like a high beta Nvidia. If Nvidia's up 2%, like Ponzi won't in for a while. But Amphenol, this is the one I'm buying on the dip. Amphenol, CEG, Comfort Systems, even EME Corp. It's actually a kind of competitor to Comfort Systems. EME is starting to look attractive. 23 forward PE. Basically, they've had a monster stock price. Almost, it was moving actually slightly better than Comfort Systems until they reported earnings and fell. But Comfort Systems had crushing earnings. They're really good ones. Eric said CSL Ltd. So you're not talking about Carlisle companies. I do own CSL, but he's talking about CSL Ltd, which is an Australian company. And luckily we can view them. So it looks like Carlisle Group did or not Carlisle, whatever it's called, CSL, the other CSL, gap down on earnings. It's Australian. My brokerage won't even allow me to buy it because they're only listed on the Australian, exchange. But they're trading at a 19.6 PE. Do they have analysts? They do. No, wait. Do they have analysts covering this one? So they slightly missed on revenue this quarter. So this might explain why they gapped out so much. They've been missing on they missed on revenue actually by quite a bit, by like 250 million. They missed on EPS by like 10 cents, and so it was a triple miss quarter, but it wasn't like the end of the world. So since they are an Australian company, they report like annually and cumulatively. But they are printing net income. Look at that, 3.14 billion for the fiscal 2025, up from 2.7. And yeah, that really was real, like not some adjustment either. Well, actually, there was an adjustment to their net income. I don't know, because the operating profit was 2.96, but the net income was over 3.14. So they must have had some sort of anyway, interesting company. I think they're like a bank or CSL Behring. What industry is this? They are vaccine company. Oh, so I'm completely off. So they're a healthcare company, sequencing. There you go. Interesting little name, Australian name there. Any stocks you like now that are under $100? Again, I never care if a stock is under $100. I'm never scared to buy fractional shares. Like right here, I saw Ferrari. I'm like, I couldn't pass this dip up and I didn't have any cash. So I only bought 0.1 shares for like $35. So the stock price, of it is usually irrelevant. Is irrelevant. So just any stocks I think are good dip on the buy. Oh yeah, here we are just looking at this. These are my high yielding lists. I am not of age, or I'm so young that I should not be in these names. But if I was wanting high yields, this is like a perfect, I've made like a dividend growth portfolio that already has a high starting yield that'll grow your dividends 10% plus a year. AbbVie, McDonald's, JP Morgan, Johnson & Johnson, Coca-Cola, even Cisco. Actually, Cisco's right at its 2001 bubble, but they totally deserve to be doing as well as they're doing. Yeah, look at this, same prices they were back in 2000 .com bubble. But so are we in the next bubble? Who knows? So, what up, Jeff Mack? Yo, shout out to the member, Jeff Mack. He's been like a member for 10 months now. He said, Taiwan Semi, let's do it. And then we'll check out Texas Instruments. What up, Nick? I actually don't love Texas Instruments, but we'll check them out because they suffocate themselves with a super high dividend payout ratio. So here's Taiwan Semiconductors right here, one of my favorite names out there. This is why I would not sell this company, or I wouldn't trim it at all. The forward multiples of 25. Literally, they're trading at 25 times next year's net income. Now, they are a Taiwan company, but we've converted the currency to USD just to get a better idea here. Their current PE is a 30, but forward PE of 25. Their market share just keeps on growing. Went from 62 to 71 for these like wafer chips, these like 2 nanometer wafer chips. They're used in everything from your car window to your washing machine to NVIDIA chips. So part of NVIDIA's moat is the exclusive deal with Taiwan Semi. But look at this. Their sales, the revenue grew 35% year over year. And look at that. The revenue was $32 billion. Again, this is in USD. They did $32 billion of revenue, and they kept an after-tax net income. Look, after they paid $2.5 billion of taxes, they netted $14.8 billion. They literally have a 45% net margin. And it's like NVIDIA with the higher yield. You get a 1% dividend. They raise their dividend every year, way faster than inflation. It's a fair valuation. Printing money, it's a great never sell stock, I think. Great dividend growth name, and it gets you exposure to, the AI. I'm going to add them right now to the good high yielders. Why not think of that? Taiwan Semi. Okay, someone said what app you using? Oh, yeah. Hey, by the way, if you want to get this app I'm on, it's actually a brokerage. It's in the link tree in my bio, very first link there. Brokerage where you buy stocks on. It's an affiliate link too, full disclosure. So if you go and deposit $100, we'll both get some free stocks. But yeah, you can just type it into Google though, broker called Moomoo. Hey, what up, Looney? Good to see you, man. Carlisle Group, I think, is a steal of a deal. We'll get to them in a minute here. All right. What was that? Someone's had a stock. Oh yeah, Texas Instruments. Here's the only thing. I'll go kind of quick about this one. It is like a chip play. Actually, they've been one of the worst performing chip stocks. They're the same price as they were back in 2021. So that's, they've been flat for a couple years, which isn't great. Intel, AMD, and Texas Instruments face lawsuits over alleged use of chips in Russian missiles. I guess that's not good. Willful ignorance. Well, anyway, that doesn't mean anything for the stock. So they make these analog. Well, how's that growing? Actually, the growth is finally back because this was lost its growth, but it's 3.7 million. Look, in 2022, the revenue was still higher, 3.9, 3.9, 3.8. Even after this, it's 3.7 right now. So it's getting back close to all-time highs. But here's the thing. Look at their net income. And this is, the real net income. They're making, if we average it out, we'll be slightly generous. They make $1.3 billion of net income a quarter. So remember that they make $1.3 billion net income a quarter. But here's why they basically don't keep any of it. They pay a dividend every quarter, and that dividend, that 3% yield that they have, actually sadly cost them $1.24 billion of net income a quarter. So they have a 95% payout ratio, and unless they grow this net income quick. So I just don't love that they kind of suffocate themselves. They can't really invest in the future, do buybacks, raise dividends, invest in robotics without having to dilute the shareholder or issue debt, which is just unfortunate. So I just don't love them for the dividend payout ratio. Someone said, Texas Instruments for robotics. I didn't know they actually had a robotics division. Yeah, look at their net margin, for example. Texas Instruments, their net margin went from 32 to 28%. Dang, whoa, after it fell 14%. Look at this net margin decline. They used to print money, 44, 45% net margins. But maybe just from the increased competition, it's 28% net margin in the most recent quarter. And here's what I was talking about, the high yield. Yeah, 3% dividend yield. I would honestly, I wouldn't mind them if they cut the dividend and full just invested in robotics and stuff. But that might explain why the stock has been flat for a little while. Ooh, let's see. We got some interesting stocks here to top. Broadcom, let's do Broadcom. I like the name. I love this stock. It's still too expensive. And hey, will not lose. I didn't even see that. Thanks for that little gift there. I appreciate that goat. But yo, Broadcom right here, the forward multiple is a 45. Honestly, for a name like Broadcom, that's fair. Still a little expensive for me to like meaningfully buy Broadcom. I would not. Like if this is the worst, like it's where it was 2 weeks ago. If this is the worst dip that it's going to have, then I'll miss it. But then I would be more comfortable getting this one at like $320. It would be an ideal price, but it might not get there. Who knows? Because they're so quality. Let me show you how they're growing. Let me actually see the earnings sum. What is it? What did they report? So Semiconductor Solutions grew $9 billion. That's what a lot of people know them for, but they have this software business that I love. So they have infrastructure software, grew 17%, supported by VMware Cloud. Their VMware, amazing. Profit margins improved. I can't talk today. So yeah, there's Semiconductor Solutions right here. This is obviously just a beast of a grower. Well, actually, I guess, what's it? Okay, 26% year-over-year growth. It looks like it did slow down back here, but while that was slowing down, their infrastructure software business was booming. Like look in the middle here, triple digit growth rates in the middle. It started to slow a little bit, only 17% year over year, but it's up 17% after it grew 199. It's holding on to that 199% growth from the last year. So they've just had phenomenal growth on both sides, and they're printing free cash flow. That's what FCF stands for. Literally in the most recent quarter, $7.5 billion of free cash flow. That's not the operating cash flow, but that's their free cash flow after the CapEx and stuff, which is just so great. And then they have the net income down here. Was that a one-time adjustment? Okay, so it was slightly. So it says they made $8.5 billion. They actually made $7.7, but it still grew 55% from the previous year. So that actually means, yeah, sales are up 28, but the net income is up 50. So that means the margins wasn't a 47. It was like a 44, we'll probably call it, but record net margin quarter ever for Broadcom, it looks like. And you get a higher yield than like an NVIDIA, 0.66% dividend yield. Another kind of high payout ratio. Let me actually do a payout ratio off this. So, they made $7.7 billion in net income this quarter. Dividend cost 2.8. So that's not crazy payout ratio. But yeah, nice little Broadcom there. What are you using? I'm using Robinhood. Yeah, if you want to get this brokerage, I do have Robinhood, by the way. Yeah, if you want to get Robinhood, by the way, they're all affiliate links, but you can just type it into Google. But yeah, if you want to get this app, this brokerage is my favorite one. Link tree in my bio, very first link. Second link in the link tree in my bio for this brokerage or Robinhood. Weeble's up there too. But yeah. Sorry. But okay. Banco. Hey, Tim, if you got a stock you want to look at, give me the ticker symbol and we can try and check it out there. So Carlyle Group, yeah. So someone said while we're looking at, let's do Carlyle Group. What up? So this is a stock I'm just barely down on. It's actually the only stock we're net down on. Out of all the stocks, our total percent change, this is the only stock we're actually lifetime down on. Actually, including all the dividends, I've been diamond handing this stock. Look at this. Each 4 quarters is a year. So actually 1, 2, 3, 4, we've owned this stock for basically 2 years now. We have a pending dividend coming in from $14. You can kind of see how the dividend kind of grew. $6.80, $8.50, $10, $12, $14. Carlyle is mainly a buyback play. You know what? Let me start this off over here to show you something very interesting about Carlyle. First off, you get a 1.33% dividend yield, and you're about to see how super safe that dividend is. But 1.33% dividend yield, but the best part is the share buybacks. Look at the very bottom left. There's 42.9 million shares. The same time last year, there were 46.5 million shares. So they've bought back 7.7% of the company. After they bought back 7% of the company, after they bought back 4.7% of the company, after they bought back 1%, after they bought back 4.9, literally, here's 2019, right before COVID, there was 56 million shares. 2020 Q1, there was 56.5 million shares. Now there's 42. That just does wonders for your EPS. So here's the EPS a quarter. Easily $4 or $5. The dividend is $1.10. So that's an easy payout ratio math just from EPS, around a 20-25% payout ratio. The business has been slowing, but that's because they sold off one of their businesses. Like if you look at the revenue, it's not great. 0.08, -1. Well, that's because remember the market cap up here is $13 billion. Well, they sold off one of their businesses to Amphenol for over $2 billion. So that was like 20% of the whole revenue, the business they sold off. So part of that is tough comps. But anyway, I love Carlisle. I've owned them for 2 years and I'll never plan to sell. I've just slowly been adding to my shares. I think it's a great dividend growth name. You get a 1.3% yield. Look, they raise the dividend. They've actually been raising their dividends for 49 years. Never had to cut it once, not a single time ever. They're almost a dividend king 1 year away. But yeah, they repair roofs. Even their presentation, they say they're less cyclical and a bit recession resilient because like even in a recession, you got to get your roof repaired. There's a leak. You're not just going to let that happen. Here's their 2030 target. I went over this on my YouTube video about this stock, but look, Vision 2030 target, again, 2030, 5 years away, but here's a cool little math. They want to get $40 plus of adjusted EPS. That would be a mid-teen CAGR to get there. Right now it's at 20, or like a $21 of EPS, but they want $40 of EPS, which would be a double from today's EPS. Part of the way to get there is buybacks, but just do simple math right here. 331. Let me pull my calculator over here. I don't want to do it on my well, that should be easy math. 330 divided by 40. I mean, if everything goes perfect, you're paying 8.2 times that EPS. You're paying 8 times net income. So that makes the dividend payout ratio. Anywho, they're probably a little biased, but I believe them. So again, you want to own a portfolio of a bunch of stocks you have a lot of high conviction in. Don't just put all your eggs in one basket, as they say. Of course, nothing in this financial advice. Of course, if you wanted to follow button, we actually stream every day, every Sunday at this exact same time we stream. I sell absolutely nothing. Please watch out for people impersonating me. I'll never follow you, DM you. I sell nothing, no course, book, coaching, literally nothing. So, all right, let's see here. Luigi said, can we look at Fly? Is that Fly Aerospace? Let's check it out here. MU will probably keep growing. MU is a beast. They did just show like their first ever, like, I don't remember. It was slowing of something, or I don't know what that was. But anyway, Signpost says, got it. You sold some of your stocks and you sold some of your stocks and want to pump the stock if you can before the dump. Yeah, hey, yeah, I'm trying to pump stocks. I have a big enough audience to do that. It's okay. So Fly Aerospace, this is a recent IPO, very small. Well, actually not too small. Actually, I thought they were worth, $3.5 billion. That's actually a sizable market cap. So this company is worth $3.5 billion. There are analyst expectations. Whoa. So this quarter, the revenue is $30 million and they slightly beat on revenue. If analysts are right, it's going to grow to $52 million next quarter and then $72 million. That top line growth, if true, is going to be incredible. And they just got their IPO funds, so they did completely deleverage. They had a lot of debt. They paid off $1 billion of debt from the IPO. So what do they actually do? You know what? Again, very small name here, but I do like that growth, so I wouldn't just... upcoming missions. Alpha launch includes, missions for Lockheed Martin, NASA, Space Force. Well, so they have some cool partnerships, maybe rocket mission. So it kind of reminds me of like an ASTS. Dude, try not to spam there. That's not cool, man. Sorry, I got to mute. I should have like a built-in thing, but TikTok doesn't do that, sadly, where you like can't spam a stock 5 times in 1 second. Or maybe I just don't know how to set that up. All right. Can you go for SMR? We can't. Oh, wait. Firefly Aerospace, I would keep the allocation low. I do love that top line growth, though. So that'll sustain the momentum if they keep hitting those numbers. Hey, someone said 8 said CARE EX, or hey, give me the ticker symbol for that stock and we'll check it out. And we'll remind me to get to Oracle too there. My bad, Hassan. I did want to get to that one. So here's SMR. We will get to that one in a minute here. Remind me. So here's New Scale Power. They're worth $5.5 billion. If you're going to buy the dip on a nuclear name, in my opinion, notice how I've always, for all of time, have recommended as my favorite nuclear stock is CEG. This one is like the best nuclear stock out there. Well, I guess it doesn't want to load, but you see how much that one's fallen? We can actually pull it up on Robinhood right here. I do own, where is it? CEG right here. They were also down bad on Friday. Look at this. They were down 6.9%. We lost $400 because of that, just on our position. But they haven't fallen from that. Like their SMR was like 50% off its all-time high. So it's because this one's ridiculously overvalued. They're worth $5.5 billion. They're not profitable, but they basically got their first ever little bit of contracts, but they have been missing on the revenue. Like analysts expected 11 million. They reported 8. Last quarter, they made 8, but they should have a record quarter in 2 quarters if everything goes perfect. But yeah, dang, no way. That can't be real. 8 million of revenue, but they net lost 530 mil of net income. Maybe that was just from a one-time expense cost from like building out a nuclear reactor. But if you're looking for this is like they maybe own, they're trying to make these SMRs, that's the ticker symbol SMR, these small modular reactors. And if you didn't know, there's only 2 working SMRs in the world and none of them are in the US. It's like the earliest one that'll maybe come online is 2030. So, in my opinion, the best nuclear play, and this is the one you really want to own, is CEG, Constellation Energy. It's just as growthy. I think like it's actually done better than that one probably, and it's done way better, more consistently as well. And this is the one I would buy on the dip. It's still tough to buy it here, but honestly, the thing with SMR though, how it's like a high beta nuclear name. If there's a huge rebound in the nuclear sentiment, this will outperform CEG on the way up by far. Yeah, interesting name here. SMR losing some money. Oh yeah, let's get to Oracle right here. Oh, CDNA. Okay, we'll get to CDNA too. OUST. Hey, what up, Greep? We'll do OUST. RAM price went up. Wait, hey, Looney, is that the ticker symbol RAM? We'll check that one out. So here's Oracle right here. Let's go look at their earnings because let's actually see what AI kind of has to say about this. So the cloud business revenue grew 34%. Before I actually read this, one of the things that sent Oracle down is they said they're delaying a bunch of data centers, which kind of sent the whole AI beneficiaries down, like Comfort Systems. So Oracle reports lower revenue growth amid AI expansion challenges. But they were saying they're delaying data centers. They're like, oh no, don't worry, we'll get back to it. Anyway, let me get back to what this was saying. I don't know if that was too helpful. Legacy software and hardware revenue declined by 3%. Okay, but the cloud business, this is a pure cloud play pretty much. Cloud business grew 34%. Heavy infrastructure investments led to a significant free cash flow decline, while operating cash flow increased 58%. Well, let me look at the operating cash flow because this is kind of like your before investments number. Went from 1.3 to 2.7, but if we look at the actual free cash flow from that, wow. So they're investing a lot in the future. Let's actually go check that out. Cash from investments. So yeah, they're spending close to 10 bill a quarter, a huge increase. So this is a pure cloud play. They have like a 6% market share. AWS is the number 1 market share. Then I think it's Azure Cloud, then Google Cloud, and then Oracle's 4th or 5th. I like my cloud exposure with Amazon and Google. But look at this. The operating profit on Oracle did grow to a record for Q2 record, up 19% year over year. They didn't actually make 6.14, but they did make around 4 when you include the taxes. That's the before tax number. Sales grew 15. The other thing I don't love about Oracle is how much debt that they have. I think for the first time ever, and let me see this. This is the bad stuff. Their long-term debt, it's now 99 billion. So they have that doesn't even include their other debt. 99 billion of long-term debt, current debt of 8 billion, capital lease obligations as well. But they're making like 4 bill a quarter, but they also pay a dividend. The dividend costs 1.44 billion. But you get a 1% yield. It's like a mixed bag on the Oracle. It's actually more expensive than Amazon, Google, and Microsoft that have higher cloud market shares. They are trading at a 35 PE. Look at the current PE. It's a 35.7, but the forward PE is a 35.8, implying there's no EPS growth. Part of that is because they had a little one-time adjustment to the current EPS. It wasn't actually $2, but they're probably still a slight bit expensive. All right. What was that one? CDNA. And then we'll look at why not like Oklo? Yeah, Oklo is really bad. Worse than SMR. They have no revenue. And let's see. OUST and GCT. We'll check out these two. So here's CDNA CareDX. I have not heard of this company before. They're worth exactly $1 billion. The forward PE says it's a loss though. So, maybe that's why they gap down so heavily. I don't know. Let's actually go look at their numbers. So the revenue, they beat on revenue this quarter. They expected 95. They did 100 mil. Last quarter they missed, but forward PE is a loss though, but they have been beating on expectations. So revenue's up 20% year over year, after grew 23, after declined 15. So I can kind of see why this stock is the same price that it was back in 20. Dang, the stock is the same price that it was in 2018. That's not great, but they're getting close to profitability. They're still okay. So actually, they narrowed losses significantly this quarter specifically. That is great news. And they have a good balance sheet too. They've deleveraged. Look at that. The liabilities used to be 42% of the assets. Now it's only 28. Cash and financing activities. So they're not diluting you as a shareholder either. So they're not like issuing shares. Honestly, it's not the end of the world for them. I mean, I this quarter specifically I really liked, because if we look at last quarter on their revenue, the revenue declined 6%. But it looks like as long as they keep up the growth, narrow their losses, get profitable, it might be okay. But the forward PE is a loss, but current PE is a 16. I wouldn't have it as a big size position. Thanks, you need a podcast. Hey, thanks, Hassan. I do appreciate that, man. That probably wasn't too helpful. You got another stock you may look at, let me know there, because that Oracle analysis wasn't probably the best. This is around what Fly's IPO price was. It shot up 200%. I remember. Oh, really? OUST. Let's check out that one. OUST. Oh, Quan said Apple. Hey, remind me to get to Apple there. I'll check out that one now. So here's Ouster right here. I think this is like a plating company, or oh no, LiDAR. So sale and production of LiDAR sensor kits. LiDAR is really popular right now because there's a lot of autonomy driving cars that use their LiDAR sensor kits. I don't remember what car company. It wasn't Google, Waymo, but I think it might have been like a Chinese company. The shortage has gone down. Only 10% of all the shares are being shorted. Let's see what their numbers are. So check this out. The growth is what I love. Like, it's straight line up, and they always beat on expectations every quarter, but the revenue from the analysts is going to go from 30 mil to 42 million, and they always beat slightly. So they beat on revenue. They're beating on EPS too, or losing less net income than expected. They did miss on their EBITDA, but yeah, they are losing a bit of money, 20 mil a quarter. That's not great, but as long as they keep up this top line growth, who cares? 40% year over year. That's very good. So, and they're making, cash flow. Okay, the cash flow of the company is negative, but yeah, as long as they keep beating on top line expectations, the momentum will probably continue on this name. That being said, I wouldn't trust them. Like, I keep this as a very small size position. I have a lot of those kind of stocks where I love them. I love the financials and stuff, but I don't want to have these as major size positions in my portfolio, like a PSIX or like a Clear Secure. Well, let me sort it by this. Yeah, like a Call Main commodity stock. Actually, Iron Mountain, I like them. So, yeah. All right. Ooh. Oh yeah. Let me get to Apple real quick. Then we'll get to Circle and AppLovin. AppLovin is a great stock. So here's Apple right here. They have been rewarded for not spending so much on AI, like to build Google Gemini and to build ChatGPT. OpenAI is costs so much money with these chips and the cloud storage needed and all that. And Apple is basically being rewarded for not spending all that money, because I think LLMs are going to become so commoditized. But Apple actually pays Gemini, aka Google, over $1 billion a year to integrate their thing. And here's kind of Apple faces Swiss antitrust for third-party access. U.S. appeal partially overturns sanctions against Apple. Permitting Apple to defend commission structure. Yeah, that was kind of one of the things, risk on Apple. If you go spend $100 in the App Store, like on Clash of Clans Gems, if you go spend $100 in the App Store, Apple keeps 30% of that, or actually 33% of it, as literally a developer royalty. It's insane. And that business goes under their services category. It's over $100 billion of annual revenue for them. It's such a high margin. It's instant 100% margin for them. They need to keep that because it adds so much to their bottom line. They need to keep that commission for the stock to do as well. Yeah, they sell hardware like the iPhone sales. You know, the iPhone, they sell like 200 billion of it a year. It hasn't really grown since 2022, but because they make like 7-10% net margins on that, but it's the services business on Apple that's great. It has nice growth as well. Then they have like the wearables, like the iPad, the Mac sales. And here's why they were affected by tariffs. They now have been like completely exempted from tariffs because Apple planned to like invest a bunch of money in the US. But yeah, the United States only makes up 36% of Apple's total sales, or where the sales come from. Like the EU is huge for them. EU is 26% of their entire business. Greater China is 15% and all these other countries too. But Apple actually, here's one more thing, then I'll get on to the next stock here. But what brokerage are you using? Yeah, hey, Abdullah, if you want to get this brokerage I'm on, it's in the link tree in my bio, very first link there, broker called Moomoo. But look at this. This is their after-tax net income. Oopsie. They made $27 billion in net income this quarter. The operating profit was $32 billion. This is the before-tax number. The after-tax net income is $27 billion. So what is Apple doing with $27 billion in net income a quarter? Because they don't, since they're not investing on AI and stuff, well, they do dividends. The dividend only costs $3.8 billion. So they have so much room to raise their future dividend. That's a great little cherry on top for Apple. But since the dividend payout ratio is so low, only $3 billion, and the cost of the dividend went down because the best part is the share buybacks on Apple. They have the largest share buyback program of any company on earth. They spend, you're not going to believe this, but they spend over $100 billion of their after-tax net income a year solely buying back their own stock. That's why Apple never goes down as well, because they buy back like just this year. I remember watching it. Like just in 2022, they bought back 7.5% of the entire company just that year, and it's so accretive. So right now, share buybacks, and they bought back 5% of the company this year, 4%, 3% this past year, and here's what that does. Like net income's up 86%. But net income per share is up by over 90% because the share part of the ratio went down, makes the EPS go higher, makes the PE ratio go down, it gives you more ownership in the company, makes the dividend cost less. So in short, the buybacks just make the stock go up. Apple's a great never sell. Tough to pay at this price though. Oh, Circle, hey, let me get to AppLovin, then remind me, we'll look at Circle too after this. You skip GCT. Oh my gosh, Ben, yeah, we'll look at GCT. And ZipRecruiter. Hey, what's the ticker symbol for ZipRecruiter? Will you continue to do these streams after college? Yeah. I thought you were going to say during college. Yeah, heck yeah. So here's AppLovin right here. They're expensive. The forward PE is a 49, but they absolutely deserve all the hype around this name. There's very few other companies that can impress me more. So like this stock, it literally went from like $50 to it's at $670 today. It absolutely deserves that. Here's why. If we go to their revenue right here, this is ridiculous. The sales are up 68% year over year, but look at the revenue specifically. It's $1.4 billion. Out of this $1.4 billion of revenue, they netted $840 million. After they paid $250 million or $220 million of taxes, like the net margin expansion is crazy. They have a 59% net margin. It's an advertising company. Their ads are so good that the SEC is investigating them. On that day, that was actually why on non-earnings news days, they dipped on this day, or maybe it was, actually, I think it was this day right here. Yeah, this day specifically, they gapped down 12% a day, recovered some of it because the SEC is investigating them because their ads are so freaking good. But they print money, $800 million of net income, and at this growth rate, look at this. Just the same time last year, they were doing $80 million net income, then it went 108, 300. It just continues to grow. They continue to expand margins. The free cash flow is even better, over $1 billion of free cash flow. This is like a pure growth name. It's significantly cheaper than Palantir, but I think like a almost better bet. If I had to pick Palantir at all-time highs or AppLovin, I'd pick an AppLovin. They're on my watch list. I would love to own that name at a much lower valuation. So yeah, I did want to get to GCT, GigaCloud. CEG. Hey, we'll get to CEG too. And Prologis. Hey, that's a REIT, right? A warehouse REIT. We'll check them out too. GigaCloud Tech. Okay, small company, 1.5 bill market cap. But check out the forward multiple. That's actually pretty fair at 12.5. Well, the current valuation is 12.2, and the forward PE is at 12.5. So that means there's not going to be much EPS growth, but maybe their current EPS is adjusted. Let's go see. What do they do? Wait, off-platform e-commerce. GigaCloud 1P. Last mile delivery service. What is that? Ocean transportation. They're warehouse. They're very diversified in terms of revenue. Let's see what they're netting. Wow. Okay. Is that real? That's after they paid $3 million taxes. They're making $30+ million of net income a quarter. So yeah, they really are trading at 12 times net income. They're deleveraging their balance sheet a slight bit too. Cash flow looks great. No dividend on this name, but off-platform e-commerce, business to business. Maybe we can check out their website right here or something. B2B, 10,000 active buyers, active sellers, fulfillment services. So streamlined transactions between suppliers, resellers, competitive ocean freight, warehousing. What Well, let me see. Where are most of their sales coming from? Is it in the US market? Okay, so the US is 75% of the revenue. Then they got these other countries. Interesting little name there. They're cheap. It's like a value name. Um, what was that one? Let me scroll up in the chat here. Uh, Oh yeah, Prologis, and then I'm so behind here. I'm like missing so many stocks. CEG2. So here's Prologis right here. This is a REIT, and these are specified where 90% of their assets are real estate, and by law, they actually have to pay out 90% of their taxable income in the form of a dividend to avoid paying taxes. So it's actually completely normal for them to have like a high yield. They have a 3% dividend yield. You don't look at the EPS either for payout ratio. So the payout ratio is actually significantly lower. But yeah, if we go, this is the number you really want to look at. They made $1.45 billion of core FFO. And let's see what the dividend is. The dividend costs $9.41. That's very fair. So, they do have room to raise their dividend if they wanted to. So, yeah, the analysts are expecting the revenue to go straight up. They acquired Duke REIT a while back, and I was actually a shareholder of that REIT. That was like 2-year-old newspaper. I wonder if they even have the ticker anymore. No, it's been delisted. But they have some great assets. Oh yeah, Circle, and then CEO Eli Lilly. Though we'll get to Eli Lilly too. This is actually your number one stablecoin play. Number one stablecoin play. They have like a 29% market share. Let me verify that. So yeah, they own USDC. If anyone's heard of USDC before, it's one of the top market cap cryptos, and it's a stablecoin. And their stablecoin market share is at a 29%. Pretty cool. The reserve income grew 66% year over year, and that's 96% of the business. So incredible. Profitability improved. Strategic initiatives included launching the ARC blockchain testnet with over 100 participants, including Circle Pay networks with 29 financial institutions. So what we're seeing is, and Visa fell crazy on this day when they announced this, that Visa's partnering, or not Visa, freaking Walmart. Visa fell on this news. Walmart, whenever you go spend money at Walmart, you pay 1.5% to Visa, and then the store, Walmart, also pays another 1.5% to Visa as a transaction fee, like on the net basis. So they're actually turning to Circle, where if you use like a Circle stablecoin card, you don't have to pay that 1.5%. And like Amazon has like their own thing. Well, they'll give you the 1.5% and just a cash back with the Amazon card, so you don't have to give any to Visa. But anyway, they basically just give that fee to you. But anyway, they own USDC. They've been crushing expectations. Analysts expected this quarter $699 million. They did $740. They beat on EPS and on EBITDA. That was the most impressive. The EBIT, basically earnings before interest and taxes, they expected $31 million. They did $81 million. It was great. They had their IPO fee right here, so ignore this quarter. It says they lost $480 million. They didn't actually. That was their IPO kind of one-time adjustment. They're actually making net income every quarter. Phenomenal growth. Actually, I'm going to re-put Circle to the top of my watch list. I was doing some math earlier. Potentially Circle might be cheaper than Adobe, based off what my friend was telling me. But yeah, they're a real interesting in there. So Eli Lilly, this is the company that owns Zepbound. Zepbound has had phenomenal growth. So it's basically the competitor to Novo Nordisk. FDA may expedite approval of Eli Lilly's weight loss pill. So yeah, they're actually working on a pill version, because right now it's like an injection, but they're they raised their dividend too. They're working on a pill version of a weight loss pill, but they own Zepbound, which is just growing insanely. I wonder if we can actually find, just like break down the revenue, but oh well. But look at this. The sales grew 53% year over year. Revenue's up 53%. And the operating profit grew 86%. Basically, the net income grew 86% year over year. The margin expansion here is absolutely insane. 82% net margins, 35% net margins. They're netting, they made $8 billion of net income this quarter. They pay a dividend. Dividend only cost $1.35 billion of net income a quarter. So yeah, get a 0.56% dividend yield. It might be expensive here. What's the forward PE? A 36. That's actually not nuts. A 36 forward PE for Eli Lilly over $1,000. I remember the stock is 680, and now, boy, do I regret not buying it now. Man, Eli Lilly is just a monster. Great stock to hold and never sell, I think. Yeah. Hey, what do you think of CRM and Broadcom? Yo, those are two good ones. I think Broadcom's a little expensive, but Salesforce, though, is actually starting to get very fair in terms of valuation. Uh, Looks like this app is telling me that there's a megaphone bottom and there's a rise probability of an 85% chance. But yeah, Salesforce, this is the software name. Software is really getting hurt by the AI thesis. So Salesforce is literally the same price that it was in 2020. So the stock has been flat for 5 years. It's kind of coiling up, I think, for its hopefully next little leg up. There's still a slight bit expensive, historically not expensive, but the forward PE is a 34. The current PE is a 35. So there's only barely any net income growth, according to them. Let me actually see. Ooh, Agent Force Service. They rebranded this. This was never called Agent Force Service. Agent Force Sales. Why did they rename the whole thing to Agent Force? That's funny. It used to not. Okay, let me actually go see what AI has to say about this. So AI and Data 360 products generated 1.4 billion in annual reoccurring revenue, up 114% year over year, with Agent Force annual reoccurring revenue, which just started, so I'm not shocked to see this, but it's up 330%. Core products included Agent Force or services, 2.5 billion and 2.3 billion. I like how diversified that they are. They own Slack, like Mule, or I think it's called Agent Mule. So, they're in sales, marketing. Here's their Slack platform right here. Slack and other, that's up 19% year over year, after grew 8%, after grew 12, after grew 52. Slack was one of their best acquisitions they ever did. Like, so many S&P 500 companies use Salesforce and Slack specifically, like Amazon does. Agent Force. So anyway, if we go to the revenue right here, the revenue grew 8.6% year over year. I think that, and it was actually lower, but they did like an acquisition of INFA. But yeah, revenue of 10 bill, and they netted, this is great news, the net income was up 36% year over year. So they netted over 2 billion in net income for the first time ever. What about free cash flow? Yeah, they print free cash flow. I really like Salesforce. I wish they were a bit cheaper though. Wow, that was a massive beat on EPS this quarter. Yeah, it must have been. I don't even think so. Look, they made 2 billion. That's after they paid 300 mil of taxes. So I think that really was a big beat. They acquired INFA. So wait, it's gone now because they just acquired them. I wanted to show that. Maybe it's on Webull still. INFA. So yeah, so this company just got acquired by Salesforce. So you can always tell when a company is. If a stock ever looks like this, where it gaps up and then stays at this price, that means they're being acquired and they're already delisted. But yeah, all this company's revenue right here, like 400 mil a quarter, is now going to be added to Salesforce too. And anyway, cool. But they are getting hurt by the AI thesis. And they want to invest 6 billion into a facility for the pill. Oh, hey, what up, Ja? Yeah, back to Eli Lilly there. Do you think Meta will open green on Monday? I sure hope so. Actually, remind me to get to Meta. I want to get to them. And Eric said, Dell, I'm new here. What's the name of this app? Yeah, hey, if you actually want to get this app I'm on, it's actually in the link tree in my bio, the very first link there. It's actually a brokerage right here where you buy stocks on. Or you can just type in Google, a broker called Moomoo. But yeah, if you want to use my affiliate link, it's in the link tree in my bio, very first link there. And if you deposit $100, we'll both get like some free stocks. Free brokerage, costs nothing, no monthly fees or lowest commissions. Okay, Dell right here. Dell, this is kind of like your super micro competitor, like chip infrastructure installation play, server rack play, and just a commodity, low margin business. But check out their infrastructure solutions group. This growth specifically was great the past 2 quarters. 44% last quarter, up 25% year over year. After grew 33%, so they're on a nice streak of growth here. What they report this quarter? Actually, Dell is like a value stock because they're multiple. Yeah, they're trading at 13 times forward net income. That's so cheaper. They're trading at 13 times next year's net income. So let's see how their net income is. I love the dividends too. Yeah, you also get a 1.55% dividend and a very safe payout ratio. We'll check the exact dividend payout ratio here in a minute. But yeah, they're easily making, if you average it out here, yeah, they really are making around like 1.3 or 1.2 billion of net income a quarter if you average it out there. So what is Dell doing with 1.25 billion net income a quarter? Well, they pay a dividend, of course. It only costs 350 million. But notice specifically, how did the cost of the dividend go from 390 lower to 350? Because of the share buybacks. This is the insane best part about them. They're spending billions on share buybacks every quarter. 1.2 bill, 1 billion, 2.3 billion. And here's what the buybacks do for you. They've actually bought back nearly 10% of the company. The net income's up by 32, but the net income per share is up by 39. So, or they bought back 7% of the company. It's just unbelievable. So it makes the EPS go higher, makes the PE ratio go lower, and it made the dividend. They're saving $40 million annually because they bought back so much of their stock, they don't have to pay dividends to those shares anymore. It's just crazy. Thoughts on NOC? Is that Northrop Grumman? Yeah, this is a great kind of defense, aerospace defense play, in my opinion. So what's the yield here? Yeah, the forward multiples are 20. They're one of the cheapest aerospace and defense plays. So a 20 PE and a nice yield. You get a 1.5% dividend yield on Northrop Grumman. Great news. Yeah, so aeronautic systems, mission systems, space systems, defense systems. How's that grown specifically? That's up 15% year over year. Aeronautics is up 6% year over year. So when we combine all that, the total revenue is up. So it has slowed. This might be why they're at a 20 multiple. A lot of the other names are kind of growing a little faster. But look at this, 4.2% growth, 1.3, -6. So kind of single digit growth. We kind of want to see that come back. But they're still printing net income every quarter. Easily, if you average it out, we'll call it 900 mil of net income a quarter. So they're making 900 mil in net income a quarter. And the dividend cost, let's see how much the dividend costs. The dividend costs 330 mil. And since it costs so little, they're even doing hundreds of millions on buybacks too. That's what I want to see in a company that just makes so much net income that they can invest in they don't suffocate themselves with a high dividend payout ratio. So they have a low dividend payout ratio. They do massive share buybacks. They're investing in the future. This one hasn't, let's see how much they're investing. They actually are investing in the future. I want to see the top line growth kind of grow here to justify this stock going up more. Did analysts expect that though? So they actually, they missed on revenue expectations this quarter. Analysts expected 10.7, they did 10.4. So interesting aerospace and defense name there. Hopefully that was helpful. Hey, Mikey, no way. What up, man? Hope you're having a great day. Okay, Rocket Lab. Rocket Lab, this is a space stock that has great growth. It's a huge space momentum company. I just don't like its valuation. They're worth, $32 billion. That's a huge market cap, but I wouldn't diamond hand this one. This is a great swing trade, like momentum stock. And it has good financials. Like that's the thing, like its financials are so good that it'll probably just continue to go higher. But it's so expensive because they're not netting anything. But look at this. Their space systems revenue right here is growing very nicely. It's up at 36% year over year. After grew 80, after grew 15. Like for the first time ever, this business was 100 million in revenue, 114 mil. It's never even been close to that before. So that's at a record. And also their launch services, it's up 95% year over year to 40 million as well. Record for the quarter. Do they have any specific news? Rocket Lab to launch Caius satellite ahead of their Japanese mission. Rocket Lab reports 48% revenue growth, outperforming competitors. Rocket Lab qualifies reusable Hungry Hippo fairing for Neutron rocket. Secures Canadian Space Agency grant for reaction wheel development. So yeah, they got the contracts. They're my favorite space stock if I had to pick one. Look at that. Whoa, that's Q3. So wait, that's really impressive. So yeah, they also acquired Geost. Yeah, look at that. So if we go to the cash from investing activities, it says they spent $207 million on an asset. Basically that was the Geost acquisition. Hey, MCO, what up, man? Hey, yeah, remind me to get to RMBS there. Should I buy at 8:30 a.m. during pre-market when the stock is at the lowest? Well, I don't. I always recommend if you like a stock and you want to get exposure to them, you should dollar cost average into them. Don't spend all your money at once. Slowly buy into them. So just whenever you feel it, no way, dude, Mikey, no way. Mikey is on with the huge gifts, dude. No way. The air dancer and the sparklers. Dude, thank you so much, Mikey. If you got a stock you want me to look at, let me know there. I do appreciate that. Thanks so much, dude. And the freaking sweaty Teddy, dude. Thanks, man. What should we check out next? Explain what buybacks are. Yeah, hey, next time we look at a buyback company, I'll explain what the buybacks are. The buybacks in short just forces the stock to go up. Did you see the dip on AMD and Powell? Yeah, hey, I did. Powell Industries is one I love. They fell 7% on Friday. A lot of stocks of my favorite companies tanked on Friday. If I go to my kind of portfolio here, let's see what I bought the dip on Amphenol stock. So yeah, Amphenol fell 7, Powell Industries 7, CEG fell by 7, Webull 5.9, Comfort Systems 5.5, and it's after a slight bit of a recovery. So yeah, AMD as well, negative 4.8. And these are all stocks we own. We are still luckily up on AMD in a lot of these names, but actually, I did buy a share of Amphenol on Friday. Check this out right here. If anyone cares, I'm still up 91% on my position. So, so whenever I bought this share, I was up like 95%. I bought it right at the market close. Like, yeah, I watched it. Before I bought the share, I was up 95%. And then as soon as I bought the share, I'm now only up 91%. I don't mind lowering my cost or raising my cost basis because I want more quantity of shares. But you know what? Let me go over Powell Industries real quick. This is a stock I do own, and it's a never sell for me at this point. I mean, we bought it at actually when I bought it, I got comments saying I was crazy. I bought it pretty much at an all-time high. It just kept on gapping up, and I was like, you know what? I'll buy 1,000 of it at $78, and then it just continues to go higher. And here's why I wouldn't sell it if I was a shareholder, and I am. The forward PE is a 22. Like they're trading at 22 times net income. That's super fair. And they actually beat on expectations. They beat on revenue. They beat on EPS. They've been beating on EPS like crazy. And they beat on EBITDA like crazy. So triple beat quarter this quarter. They actually have no debt whatsoever. It's a completely debt-free stock, no debt whatsoever, and $475 million of cash. Now, they have some liabilities, but they basically got paid up front. They have a $1.5 billion backlog plus let me mention that $1.5 billion backlog, $500 million of cash. The whole company is worth $4 billion. So when you do an X cash PE multiple plus other inventories, they're really trading like a 18 forward PE on an X cash multiple. But yeah, they're making 50 million net income a quarter. Remember how they had 450 million of net cash? And they have 150 million of those liabilities are orders that they've gotten prepaid for and that they're going to fulfill, but they kind of earn the difference on it. So whenever they get paid this upfront cash, they're keeping it in these 1 to 3 week treasury bills and they're earning interest on it. So they literally made 4.3 million in positive interest. If a company has debt and they're paying interest on their debt, this would be negative right here. Like a long time ago, they've really always had a net cash position, but so they made 4.2 million of interest on their cash this quarter. This company also pays a dividend, and the dividend only costs 3.2 million. They're making more interest on their cash than the cost of the dividend. So this basically, what's the yield here? A 0.3% dividend yield, 7% payout ratio is basically free. 7% payout ratio for 0.3% dividend. So you basically have another 7%. They're making so much interest. It's crazy. Anyway, I love Powell Industries, huge backlog. They make switchgear solutions, custom projects, really cool company. Broadcom, yeah, they reported earnings and fell on earnings. They, I don't know. The earnings seem very well. I think Broadcom's just kind of getting back to a normal valuation. Broadcom was super expensive. Looking at RCAT on the rebound tomorrow, what do you think? Yeah, look at RCAT, and then we'll get to RMBS. Hey, sorry about this. Can I give you a combo of stocks? Yeah, Mikey, do it. Yeah, let me know. We'll check them all out, dude. Thanks again for all those gifts there, Mikey. The SpongeBob's, the Christmas things, the Tom Christmas, dude. Thanks for all those gifts. And and even the paper crane. No way. Yeah, let's. So here we go. Here's Red Cat Holdings. This is a drone play. I believe like a couple months ago, they got NATO approval to sell their Black Widow drones. Let's actually go see right here. What does the earnings have to say? So defense segment expanded with the 35 million Black Widow drone contract and NATO approval. There we go. Enhancing international market access. So all the NATO members, they launched Blue Ops Maritime Division, focusing on uncrewed surface vessels. So without unmanned, basically drones, but surface vessels. Let's see, are they making money though? And what are the expectations? Wow. Well, it's still small, but that's great. It's literally, the sales are going to go from 1.6 million. And if they meet this number, to 23 million in a year. So if you're a shareholder of Red Cat, the next 6 months are going to be extremely volatile as they basically have their first ever revenue. Because here's their right now revenue, 9 million. But next quarter is supposed to be 20 and then 23. So how much money are they losing? So, I mean, 15, 20 mil a quarter, that's not too bad. Oh, and they just fortified their balance sheet. Let me guess, from diluting you. Yeah, so they diluted you by 165 mil, 70 mil last quarter, but they basically are set forever because they now have 206 million of cash. So yeah, they diluted you by 165 million, but maybe that's also why the stock went down so much, because they rose cash, fortifying their balance sheet. Now that doesn't work. So they're in a good position. But I wouldn't have that as a meaningful size position. So RMBS. Yeah, hey, try not to spam in the chat there. We'll try and get to all these. Yeah, hey, what up, Omer? We have a few in the backlog here. USAR too. We got a few stocks I got to get to first here. I apologize. But here's Rambus. We'll be streaming for another hour. Don't worry. If I'm missing your stock, we're going to be streaming at least for another 2 hour or 1 hour and 20 minutes. We've already been out of live for over an hour. So this is fun. So check this out. Here's Rambus right here. The current valuation, they trade at 44 PE, but the forward PE is a 38. So they are expected to grow their net income by a bit. And wow, they've done great. Stock was $16 pre-COVID. Now it's 94. So that's nuts. So semiconductor space. Okay, that makes sense. Probably why their stock is done so good. You know, the semiconductor industry from AI is just booming. So they're beating on expectations every quarter. So no wonder they're gapping up on earnings days. So they beat on revenue every quarter. This quarter, they did miss on EPS. Maybe that was a one-time adjustment, though. Let's see. So the net income was $48 million. But yeah, the operating profit, the core business actually grew 26% year-over-year. So yeah, they really did make a record Q3 profit. But yeah, sales are up 22, after grew 38. They have a really good balance sheet too. Look at this. That just adds safety. You know, they have $670 million of cash. Are they earning interest on that? Let's see. They are. They made $6 million of just interest on their cash, because I love companies with so much net cash position, just like Powell Industries, even Google, Meta. They all make so much interest on their cash. Yeah. Anyway, yeah, everything here is headed in the right direction. It might still be a little expensive, 38 forward PE, but good numbers there. Semiconductor play. USAR. So let's see here. USA Rare Earth. Ooh. And then we'll do NextEra Energy, CEG. I have actually a really cool stock I want to share with you too, Mikey, another utility. So here's USA Rare Earth, probably one of the rare earth mineral beneficiaries. US Rare Earth accelerates round top production timeline to 2028. So mine to magnet value chain. Okay. Let's go see here. I don't know if this is one of the companies that the government took a stake in. I know they took a stake into, we'll look at that actually in 2 quarters, they're expecting their first ever revenue. Because if we go to the right now revenue, it says no data because they've never sold anything. But in 2 quarters, it looks like they're expecting $3 million of revenue, which is good. Yeah, they lost $250 million in net income. So they had to, that just added leverage to their balance sheet. They used to have, Anyway, I would keep the allocation very small there. So actually, if we go to ticker symbol VPU right here, this is the Vanguard Utility ETF. And 2 of those stocks you mentioned, NEE and CEG, those are the top 2 utility companies. Check this out. In the VPU Vanguard Utility ETF, which market cap weights it, NextEra Energy is the largest utility out there with a market cap of $170 billion. The second largest is CEG with $109 billion. And then third is SO Southern Company. And for the first time ever, I actually just bought ticker symbol SO Southern Company because they have a 3.5% dividend, 19 PE. So you should, in my opinion, get 3.5% dividends and then hopefully 3 to 4% stock price appreciation every year for 7% total return. Not beating the S&P, but still a better alternative to a money market. But NextEra Energy, I actually like SO slightly more than NextEra. NextEra is the same price that it was in 2021, but they actually just opened up this nuclear reactor with Google. Yeah, look at this. NextEra Energy expands partnerships with Google and Meta for clean energy and data centers. There was a nuclear reactor thing. NextEra Energy and Exxon partner for carbon updated power plant for hyperscalers. They're doing a lot of partnerships. NextEra Energy and Exelon, whoa, they used to own CEG, approval 220-mile transmission line project, natural gas plant. So just AI right now needs a lot of infrastructure in demand, like energy, and NextEra Energy is the number 1 utility out there. They're a regulated utility. That's why I think CEG will grow more, and that's actually my favorite utility. If I had to pick any utility out there out of the whole ETF, CEG, NEE, SO to Diamond Hand forever, to Diamond Hand to never sell, I would pick CEG. They are the best. I think they're going to be the most growthiest. It's a slight bit hard to, they were down 7% on Friday. Still a little expensive, but that's my favorite one. But yeah, they own Florida Power and Light, pretty much all the state of Florida. They own, it's basically a local monopoly, kind of like every utility is a local monopoly, but they own Florida Power and Light, and they print net income. Look at this. They had a one-time adjustment this quarter. They didn't actually make $460 million. They're making, if we average it out here, they're making $2 billion of net income a quarter, just under that. So if they're making $2 billion net income a quarter, the dividend cost 1.17. So they have a safe around 55% payout ratio. So, yeah. There's Next Day Energy. It's a safe, good yielding one too. If you look at the dividend yield, a 2.7% dividend. Actually, Southern Company has a higher yield and has done better, which is kind of weird. CEG has the lowest yield, but they do share buybacks and they do crazy M&A. CEG right here. This is the number one nuclear play out there. There is no close second. Nowhere near close. They literally own 33% of all the U.S.'s nuclear reactors, like 20. Oh, yeah, and they're acquiring Calpine. And this Calpine acquisition, I kid you not, is instantly accretive $2 of yearly EPS. Crazy. And it says it was $16 billion. The net cost is $26 billion. So it was a great asset to own. So, yeah, low dividend yield, 0.4, but low payout ratio. Notice the growth of the dividend. And I've owned CEG for a long time. And this Calpine acquisition just is amazing. Yeah, look at that. All the history you can see there's the dividend. So look at this. Every four quarters is a year. So I've owned CEG for now a year and a half. And these are all the dividends I've received from them. And again, the dividends are low now, but you're mainly buying them for the stock price appreciation. The dividends are like the cherry on top. Which app are you at checking? Or yeah, hey, or this, if you want to get any of these apps, they're all brokerages, where you buy stocks on. They ask for a bunch of information. They're all in the link tree in my bio. The one I'm on right now is my very favorite one to do analysis, lowest fee brokerage. Very first link in the link tree in my bio. And let's look at UTG, last one here, UTG. This is the Reeves Utility Income Fund. So yeah, this looks like an ETF you buy to maximize your income. Let's see the yield here. Wow, a 6.3% dividend yield. The dividend is flat the payout of $2.28 is flat every year, maybe slightly down. And the stock price, the actual price of UTG is the same price that it was in 2019. So here's kind of actually, that's not too deep. So you get 6.3% of your money back every year since 2019. So that has massively underperformed the S&P 500, only 6.3 or basically 6.4% returns a year. But unless you bought the dividend, yeah, I wouldn't buy this one unless you just want to maximize your dividend income, because that won't even outperform the S&P. And that's just not just them. It's kind of all, I think they're doing selling calls. I think all the kind of covered calls do that. So yeah, let's check out Pagaya Technologies and Fortinet. Yo, Eric, we'll do Fortinet, Eaton. I really like Eaton. Eaton's your electrical infrastructure play. I think Eaton should acquire Powell Industries, or like a Simmons should. Please like it, will help the channel. Hey, Steph. Hey, I didn't even pay Steph to say that. Hey, if you are enjoying the stream, hit the like button. By the way, we stream every single day, every Sunday, this exact same time. We're also going to be doing another 3-hour live stream at 8 p.m. tonight, or in exactly 7 hours and 20 minutes. So basically in 7 hours from now, we will be live again. Like for sure this time. I had an issue last week, but anyway, and I sell absolutely nothing. If you wanted to follow button, we stream daily and I sell nothing, literally nothing. I have no course book, WhatsApp. I don't coach, literally nothing. Please watch out for people impersonating me. I'll never follow you or DM you. So check out PGY right here, Pagaya Technologies. The revenue growth looks great. The sales are up 36% after grew 8%. So actually the growth rate is like growing on this company. And for the past 3 quarters, they're net income positive. So looks like they lost 250 mil, but that was a one-time adjustment. The core business, though, look at that record profitability. So let's see these margins here. Net margin, well, the comps look tough because there was that one-time adjustment. Anyway, let's see. They beat on expectations this quarter. Analysts, that's the orange line, what the analysts expected. They expected 341. They did 350. They beat on EPS and they beat on EBITDA. It was a triple beat quarter for them. Where does the revenue come from? 100% if it comes from the United States. What does this company do? Data science, machine learning. Maybe you can check out their website right here. Looks like they got a partnership with SoFi or something. Instant seamless send customer loan applications, or maybe like some kind of wow, 3.2 trillion in loan applications, trained our AI models for smarter data lending. So pretty interesting. There's some kind of fintech kind of financial loan software name that's profitable now. Let's go. Ooh, someone said TE. I think that's TE. T1 Energy. Actually, this is a different one. All the energy companies are in just such demand. Well, actually, not Actually, this stock isn't done well. It's lower than it was when it IPO'd, but it has seen some recovery. Manufacturing and subsequent sale of photovoltaic solar modules. So like a solar company. Oh, whoa! Look at the growth expected. This is probably why the stock has had such a monster performance from literally $1 to 5, or it's 7, or no, it's 5 right now. But the revenue is, if the analysts are right, next quarter it's going to be 420 mil. Like this quarter it's 200 mil, it's going to be 420 mil. Then it's going to be 260 mil. So there's a lot of future growth expected. That's really interesting. They developing battery solutions. Let's check out their website really quickly just to see T1 Energy Advanced. Yeah, it looks like some sort of solar and battery supply chain. Okay, looks like they have headquartered in Texas. So there you go. Looks like a solar beneficiary. Oh, Procter. Let's do Procter and Gamble real quick. I just added a small position in WDAY. Oh, I think that's Workday. Um, we'll check them out too, if you remind me. So here's Procter and Gamble. This is like your staple company. Hey, whoa, dude, Sheepadoodle. No way. Or Sheepadoodle with the cool freaking SpongeBob gift. No way. The SpongeBob and Patrick Star. I didn't even know TikTok was doing that collaboration or whatever. Thanks for that. No way. We'll check out Nebius. Yes, sir. We'll do Nebius after this. So here's Procter and Gamble, a great staple. They own so many billion-dollar brands like Tide and Old Spice and Gillette. But the growth is kind of gone, or their organic growth right here. What was it? 0. So here's the thing. If we go to the revenue right here, if we add inflation, this doesn't really beat inflation, 2.9, 1.7, 2, 2. So low single digit top line growth. But, I'm not shocked in this environment with how the consumer is slowing down, but this is such a safe company. You just want to never sell. I mean, the net income is basically, if you average it out, it's over $4 billion of after-tax net income a quarter. What are they doing with $4 billion net income a quarter? Well, they pay a dividend. The dividend only costs $2.55 billion, and since they have leftover money, they're doing over $1 billion of share buybacks a quarter as well. They're so shareholder-friendly company. So yeah, if you buy the stock right now, you get a 2.9% dividend yield and share buybacks. You know what? We have to put this one on our good high yielders list because I trust them. We've been adding up to this watch list, and we'll get to Nebius after this. If you're looking, I am not of age where I should not own these kind of stocks, and I don't. I own like some of these, but actually not even like I would happily own every single one of these stocks, and I probably will at one point. This is like a perfect like dividend portfolio that has like a good starting yield, like Coca-Cola, Cisco. This is like if I had to make SCHD, this would be my own SCHD. Procter and Gamble is an addition. Hey, Monkey D. Luffy. No way, man. Thanks for that. So let's check out Nebius right here. You know who actually owns Nebius, which is kind of cool, is NVIDIA. Astera Labs is another one, that's a different company. I was thinking of APLD, or yeah, someone said APLD earlier. APLD, CoreWeave, and Nebius, they're all basically the exact same thing. Nebius, CoreWeave, APLD, they all just own. It's nothing really proprietary, and in the long run, I sadly think they're the bag holders. Buying these crazy expensive chips with the depreciation curve and all that, but Jim Cramer shorted this one, so maybe that means you should buy it. They're headquartered in the Netherlands, but yeah, they basically just own a bunch of GPUs in a data center. And check this out right here. What I've loved is the top line growth. It's insane. They got a huge deal from Microsoft. So basically $16 billion of the Microsoft Azure cloud is going on Nebius's servers. Microsoft didn't want to, have that liability. So they gave it to Nebius, which is great for them. Look at this. The sales went from 32 mil to 150 mil. They're basically renting a cloud capacity from Nebius. Because they're converting their GPUs from like Bitcoin mining to cloud server hosting. So the revenue literally went from 32 mil to 150 mil. They're still burning through a lot of money. They're losing 100 plus million in net income a quarter, but it's the top line growth. Like literally it was 150 million this quarter, a record. It's supposed to be 469 million in 2 quarters. And they're supposed to narrow the losses to only 66 million of losses. So interesting kind of cloud play. And it's like a high beta momentum. Whenever the AI stocks are booming, the kind of AI data centers will do good too. I DCA into SHD every week. Hey, Sheepadoodle, what's up, man? Yo, these are all, if you like SHD, these are ones that I think they don't have as high as a yield, but these are all great stocks. And a lot of these are in the SHD. All right. Let's see here. Joe Omar, we looked at PGY like literally 2 minutes ago. What's up, man? We already looked at them. We looked at that way. Okay. I put 1K the other day in QQQI. Oh, hey, that's another covered call ETF right here. So yeah, this is one of the better covered call ETFs. But yeah, you buy this to maximize your income because like we know the Nasdaq 100 is well above like its pre-tariff dip here, but this ETF is the same price that it was. You buy this to maximize your income because check this out. The dividend yield is a 13%. They sell calls on the Nasdaq, and that's an asset you want to sell calls on because you get such high premiums and AK such high dividends. But yeah, they're not actually dividends, they're distributions because it's income from options. So it's non-qualified dividends. But yeah, it's one you buy for the monthly high yield. What site are you using? Yeah, hey, Faust. Yeah, if you want to get this brokerage I'm on, it's called Moomoo. Yeah, thanks there. It's in the link in the description, actually. The link tree in my bio, very first link there if you want to get this little brokerage, this app I'm on. Okay. Yeah, hey, what up, Faustin? I missed some stocks here. What was that stock I wanted to look at? Oh, well. Novo Nordisk or let's do Astera Labs real quick. Yeah, ALAB. Hey, Plasma. So Astera Labs right here. This one is even partnering with ARM. Now they're expensive. So the forward multiple is a 98. So they trade at 98 times next year's net income. But this is a stock that absolutely deserves a high multiple. I love their numbers. Yeah, Sheep said covered call ETFs are bad if you're under 50 and you have it in tax. Well, yeah, you buy covered call ETFs when you actually need the income. Like if you have a covered call ETF and you're just reinvesting the income, you probably shouldn't. Or there's a hidden opportunity cost to these covered call ETFs and high yielding stuff. It underperforms the S&P 500's 8 to 10% CAGR. And so anyway, Astera Labs are here. Check this out. They have been crushing expectations every quarter for the past couple quarters. That's the orange line there. Every quarter they beat on expectations. Like this quarter they expected 206, they did 230. And the EPS, this is the best part. They expected 23 cents, they did 50. A beat by over double. Everything here is headed in the right direction. The revenue's up 103%. After it grew 206%. And out of this 200 mil of revenue, they netted 91 mil. They're finally profitable. Like they used to lose a bit of money, used to look choppy, but now they're consistently making a boatload of money. And even to add more safety, like this just takes a lot of risk off the table when a company has a fortress balance sheet like this. This company literally has 1.13 billion of cash and no debt whatsoever. And since they have so much cash, they're earning interest. They made literally 11.5 million of just interest on their cash because they're so cash rich heavy. It's just incredible. The free cash flow is insane to 100 mil, 65 mil, incredible growth rates year over year. So they're still expensive. Like I think that's why they're falling, 98 forward PE. So it's even after this dip, it deserved, dang, it fell 14% on Friday. It's still overvalued, but I had that one to the watch. It's a great growth name, I will say. So yeah, let me do Novo Nordisk right here. I have some bad news about this one, sadly. Covered call ETFs, yeah. Yeah, hey, Omar, we looked at PGY like 5 minutes ago when you said it. I'm also streaming on YouTube. If you miss anything, I'm also streaming on YouTube. You can like rewind it, watch on the YouTube replay. My YouTube channel is called Nathan Roberts, also in the link tree in my bio. But here's Novo Nordisk right here. This is your weight loss play. They literally own Ozempic and they own Wegovy. And they've had a massive decline in stock price because there's a lot of increased competition from Eli Lilly, Zepbound, and also they lose their exclusivity. They lose their patent for Ozempic in a couple years, 2-3 years. So we can see actually Novo Nordisk just acquired a $4.7 billion acquisition of Akero Therapeutics. That's actually pretty cool. What's the market cap? They're a huge market cap, 220 billion. But the sad part is, if we look at their current valuation, they're trading at 13.6 PE. That might be fair for Novo Nordisk. Like, considering they're losing their exclusivity and they're missing on expectations. Like if you look at the orange line right here, what analysts expected, they expected 12.1 billion. They only reported 11.78 billion. So it was a huge miss. It's because they had to cut the price of their Ozempic so much. Like Elon Musk is on Ozempic. It's a weight loss. Like look at this. 93% of this company's revenue is their diabetes and obesity care products. And so if we go to the revenue, again, this was a big miss on revenue, but the revenue was up 10%. So the sales grew 10%, but the net income, the profits actually fell by 22%. And that was real. The profits, the margins really did decline. So their net margin went from 38 to 26. It's a nasty little decline. So I think like with all those conditions, like missing on expectations, losing margins, It might be fair around a 13.6 PE, which is unfortunate. We want to see them start to meet expectations. I like that they're doing acquisitions. They tried to acquire Metsera, another weight loss company, but Pfizer actually outbid them. So you get a good yield here, though. You get a 3.64% dividend. Like, still, for right now, they're still printing money. 3-4 bill in net income a quarter. Like, no bankruptcy risk there, obviously. But the future growth worries are why the stock is struggling, I think, right now. They also Ozempic got added into Medicare, Medicaid, but they agreed to cut the price of it by 50% plus. So the margins because of that are going, that's why their margins fell so much, because they're agreeing to lower the price of Ozempic because it was $4.99 a month. There was some other news. They announced another one. What was this? Yeah, they're doing in India right now. You can now get in India Ozempic at $24 a week. If that was in the US, it'd be way higher. But $24 a week. Anyway, let's go look at some more stocks here. I just added a small pieces of WDAY, Workday. I'm starting to like Uber. Hey, Muhan, let's actually check out Uber after this. Yeah. What about NVIDIA? Hey, remind me to get to NVIDIA, troll. What is that app? Yeah, hey, if you want to get this app I'm on right here, user 3, it's in the link tree in my bio, very first link there. It's a broker, full disclosure, it's an affiliate link, so if you go and deposit $100, we'll both get some free stocks. But yeah, lowest cost broker, costs nothing, no fees. A lot of people like it for their APY, idle cash stuff. So WDAY right here, Workday, and it just has useful analysis tools. $59 billion market cap. The current valuation is a 94, but the forward multiple is a 49. So there's a lot of future growth expected, but weirdly, the stock is the same price that it was in 2020. This might be another software. Oh, this stock is just like a Salesforce. So yeah, okay. I remember them now. So they have this subscription service. I love subscription model companies because it's all reoccurring revenue. And check this out. I mean, it's up 15%, after grew 15, after grew 18, after grew 23. So they're on a nice streak of subscription growth. I mean, check that out. That's what you want to see for growth companies. So here's what we're seeing. Subscription revenue is up and to the right, but the stock price has been flat for 5 years. It's being hurt by the AI thesis, just like Salesforce. It's actually the same with Salesforce. Salesforce is also the same price that it was in 2020. But they're making great net income. Yeah, record profits now. That's great margin expansion here. Profits went from 165 to 264. That's phenomenal. So what about free cash flow? Yeah, they're making, whoa, that's great free cash flow numbers, 500 mil to $1 billion, but they're still expensive. That's the thing. The valuation of 49 is still expensive on Workday. So sadly, it might be fair at this valuation. They probably deserve to be at where they're at today. So actually, let's do NVIDIA, then we'll get to Uber. So NVIDIA right here, dang, yeah, NVIDIA's at 175. They're a dog cheap valuation, a 26 forward multiple. You can easily justify $250 stock price on NVIDIA. I do think that this one will keep up, if not slightly outperform the market in the long run, give you a 10% yearly return. The law of large numbers does concern me a little, because the whole company right now at NVIDIA is worth $4.25 trillion. For you to double your money, they have to be worth basically $8.5 trillion. It's just a harder double than, some of them may be AI beneficiaries, but I still think this one's going to keep up, if not outperform, the S&P 500. Well, let's see what this has to say. Data center revenue surged 66%. I may actually just show you this right here. Yeah, their GPU market share, they have a 24% market share. They have this automotive software as a very small part of their business. But if another company can pull off these numbers, they deserve NVIDIA's market cap too, because check this out. The sales grew 62%, after grew 93, after grew 205. So incredible streak of growth. And look at this. They did $57 billion of revenue. Out of this $57 billion of revenue, they netted in net income $32 billion. That's after they paid 3-4 bill of taxes. So they really do have a 55% net margin. It's insane. 32 bill of net income. They also took a stake in Intel and Nokia, and they own a stake in a bunch of different companies. Actually, check this out right here. If we go to NVIDIA, we can see their whole portfolio right here. They own a big stake in CoreWeave and APLD and ARM and Nebius and RXRX and some other trash names. Let's do Uber right here. So Uber, this is, I really think, a nice valuation software name here. It is a software to cover for incumbent and business finance departments. Oh, Eric is for Workday. Eric has used it Workday. I've never used it, so there you go. Someone says it's a not great platform. So here's Uber right here. The forward PE is a 25. I mean, for Uber, I think that's so fair. So you're paying a 25 forward PE for Uber, and all their metrics look great. Like we can see they're not just active users, but these are their monthly active consumers. It's 189 million, when this exact same time last year was 161 million. So their monthly active consumers are growing. And if we go down here to their net income, here's why we're looking at the forward PE, because if we look at their current PE, it says they're trading at 10.9 times PE. That's not true, because they had a one-time adjustment. It says they made 6.65 bill in net income. Well, they didn't actually. They only made 1.1 bill. It's still a record Q3, incredible quarter, but it slightly adjusted their EPS to over $3 when it really wasn't. So the forward PE of 25, though, is still so cheap for Uber. They print money. Like, look at their free cash flow. Over $2 billion of free cash flow, $1 billion in net income a quarter, and they're taking acquisitions and stakes into a bunch of different companies, like Grab, for example. If you're wondering what is Grab, this literally does the exact same thing that Uber does, but it's international, basically international Uber. And it gave Uber instant international diversification, like Singapore, Philippines, Indonesia. You notice the US and Canada isn't on here, so it was genius. And if we go down here to the shareholder, yeah, Uber Technologies is the largest shareholder of that one too. So I think Uber owns a lot of like, what is this app and how much is it? No, hey, Paulo, what's up, man? This is a free brokerage right here. If you want to get this app I'm on, it's in the link tree in my bio. Very first link there. You don't have to deposit any money, and you can still do analysis on stocks. But yeah, if you go and deposit $100, it's an affiliate link. We'll both actually get some free stocks, and it gives you access to like certain other features too. But yeah, it costs nothing, no bro. You can just download it for free, and you can see most of these metrics that I can see. The only ones you can't are like these two up here. It says member right here. To be a member, it costs nothing. Your portfolio just has to be worth over like, I think like $1,000 or something. But yeah, you can be like, well, the bulls anyway. Okay, Lululemon. Lululemon and Viking Therapeutics. Viking Therapeutics just can't get. I'll show you why this stock is bleeding out. So look at this right here, and this was now 2 years ago. I remember it like it was yesterday, but they got FDA approval. They're finally able to sell their product. They have no sales right now, and that's the sad part. They still have no sales. If we go to the right, if we click on revenue right here, it says no data because they've never sold anything. They've never sold a product or service. But back here, they got FDA approval. Sentiment's in their favor now. They're finally about to sell a product, but it's been years now, and they still haven't even gone to release a product. And so if we go to the revenue, it says no data because they've never sold anything. And if we go to net income, they're burning through a heck of money. Just this quarter, 2025 Q3, they lost $201 million of net income. When you lose money, that has to come from somewhere. So notice how their cash pile, their assets are just slowly going down every quarter. It's unfortunate. Yeah, I just be so careful with that one. They're still not expecting any revenue for another 6 months too. All right. Let's see here. They think earnings will decrease because PE is only 10. Yeah, hey, I like Uber here too. Yeah, that forward PE is very fair. Oh yeah, hey, yo, you want me to get to eat in there, Plasma? We'll check that one out. Someone said invest in Circus City, Blockbuster, MySpace. Toys R Us is another good one to buy in. So anyway, here's Lululemon right here. What's their forward PE? So they have a 17 forward multiple. If we look at their current multiple, it's a 14, and the forward PE is a 17. So they're actually their net income is supposed to fall by like 20%, but they had great reaction to earnings. Let's go see what their earnings were. So they beat on revenue. They expected 2.47. They did 2.56. They beat on revenue. They beat on EPS, and they beat on EBITDA. So it really was a triple B quarter. So yeah, sales are up 7. So the sales are up by 7, but the net income is down by 12.8, and that's real. The operating profit, like the net income, really did fall 12% year over year, which just means their margins are being hurt. Their net margin is like the lowest it's been in years, but that's still not the end of the world, because even at a 12% net margin, that still makes them $300 million of after-tax net income. After they paid $135 million of taxes. So what are they doing with all their cash right now? That $300 million of net income a quarter? Well, they're doing buybacks like crazy buybacks. Look at that. They spent 200 mil this quarter, 300 mil last quarter, 400 mil, 300 mil. So here's what those buybacks do for you at such a cheap valuation. So the net income, again, it fell by 12.8. Net income's down by 12.8, but the net income per share is only down by 9.8 because the share part of the ratio went down. Remember, the net income and the EPS growth rate should always be the exact same thing. The only thing that changes it is if they either diluted you or bought back their own stock. So yeah, women's apparel, like comp sales. Yeah, that's what I wanted to see. So yeah, 1% comp sales. Yeah, so the growth has slowed, but it's basically, it must have been overpriced in. Like it was an overreaction for it to fall from 400 to 160, and now it's recovering some of that. I don't know. I still don't love Lululemon, but they certainly make good net income. Kind of reminds me of like a Chipotle, because they're still making good net income. What chart or broker is this? Yeah, hey, if you want to get this broker I'm on, it's in the link tree in my bio. Very first link there. My favorite broker. Path stock, UiPath. You know what? I actually own this company right here. They're expensive. They're really expensive. Let me see what this is. Any news? UiPath achieves first ever GAAP profitable quarter. So yeah, they've always had negative GAAP net income because of their stock-based comp. That's not included in GAAP. So that's why you always got to blend all the metrics together. Like they're making good free cash flow, but the free cash flow doesn't include the stock-based comp, which sends the net income negative, but you still don't look at the net income because it's also being adjusted by their net cash position. That's making them a bunch of interest. Here, I'll show you that. Like they have so much cash on hand, it made them 11 million, or they're making 10 to 12 million of interest on their cash a quarter. If you go to that core business, like last quarter, they lost 20 million, they lost 16 million, the core business did, but their net income was positive because the interest they made on their cash. Anyway, they had a good quarter. This quarter, let me see what they expected. So they beat on revenue, they beat on EPS, which did have a one-time adjustment, and they beat on EBIT. So they really, really was a triple beat quarter. It says they made 198 mil in net income. They didn't actually. They only made 13 mil. So what's the forward multiple? Okay, so this is why it's expensive. They trade at 98 times next year's net income. You probably want to do a 2-year out multiple because they just got profitable. But that all being said, I'm a shareholder of UiPath, and I have had a bad experience with them. So we got 100 shares. We actually trimmed a lot of it at 1920, 1940, or it's at 17 today. But look, we were buying UiPath, if you look in the very bottom right, and all these orders are in 2021. So we've legit been diamond handing this stock for so many years. They're kind of just being out innovated by all the other software names to the point where they're partnering with like Gemini and OpenAI and Snowflake. But that's actually seen as good right now. So anyway, I don't love UiPath. I wouldn't have it as a big size position. And I'm kind of looking to get out of them if I can get it. If I can get positive, I'll have a position. I'll sell out of it. How about thoughts on TGL as a buy at the opening bell? TGL, Treasure Global. So I don't like these kind of stocks. If you look in the very top right here, it's just hard to trust like money in these stocks. I mean, it's at an all-time low, and if you look at the market cap, the whole company's worth 10 million. The whole company's worth $10 million, and because of all the reverse splits it's done, the stock was like 132,000 before. Yeah, the whole company's worth 10 million. Let's see what the net income is. So if you kind of think about this from a logical point of view, let's say you buy the whole company for 10 million, or you buy in at that valuation a bunch of the company, like you buy the whole company, you're buying a company that lost you, 1.7 million. And that might not seem like a lot, but when your whole company is worth 10 million, that's 17% of the whole company. The quarter before they lost 3.6 million. So it's just, I can't really trust this name. Are they growing the revenue? No. So look, the revenue's gone. They have no sales basically anymore. 180,000. That's the lowest sales ever. Yeah. It's maybe like pure momentum trade, like a swing trade momentum play. Yeah, because look, there's a lot of momentum. It was just at $58, but it got completely sold off because there's no fundamentals to justify that rally. That's what sustains a rally, I think, when a company just has great financials. That's why, like, Lucid is at an all-time low. That's why we look at financials when we're analyzing stocks here. It explains why Lucid's at an all-time low and why Palantir and AppLovin are at all-time highs, or fill in the blank. Here's another one I can't trust. Sadly, if this is why I just like giving you my own little perspective, just based off of just pure financial point of view, this is not a good stock to buy, I don't think. If we go to the revenue right here, it says there's no data on the revenue because they've never sold anything. They've never sold a product or a service. So it's a revenue-less company, and they are burning through an absolute ridiculous amount of money. 400 million just this quarter, 300 mil, 98 million. So, and here's one more thing I want to show you. Is the dilution they're doing. So because they're losing so much net income, they can't afford these losses. They're not raising debt, but they're actually diluting you. You won't believe this. This exact same time last year, there were 398 million shares. Now there's 660 million. You've been diluted by 66%. So you own 66% less of the company than you did a year ago. So they diluted you 66% after they diluted you by 48%, after they diluted you by 22%, after they diluted you by 5%. This is one of the worst stocks I've seen in the market. So that's why if you go to one of my most recent posts, I made a post called The Magnificent Seven, and I added Archer Aviation to that list. They have a big shareholder like Stellantis. They own Jeep and like Dodge. They're a big backer, 8 points, but it's just, I just can't justify it's a $6 billion company with no sales, burning through a super unsustainable amount of net income. The balance sheet looks good though. Why does the balance sheet look so good? It's in the expense of shareholders via stock dilution. So anyway, that one just scares me just from a pure financial point of view. Nick said, are you still in bull? Absolutely. Oh my gosh. These brokerages keep trying to give me offers. So anyway, oh my goodness, what I just clicked there. Okay, yeah, here's my Roth IRA right here. I do own Webull still. Nice little stock. I don't like them as like a super big position. I don't love their current valuation either, but I love them though, so I think it's worth earning a little bit amount of it. And I do own a little bit of them. Snap is gonna snap soon. You know, Snapchat actually, wait. Yeah, they're actually in a lot of heat right now because, well, this is probably going to make them a lot of money. So for Snapchat, you have to now pay them. Basically your memories from 1 year ago are all going to get deleted unless you start paying them a crazy monthly fee. And I kid you not, there's so much like I hate Snapchat for that. Like I may never use them again, but as a shareholder, though, that should be great news. That should make Snapchat a lot of money, and their subscribers should go up. But they kind of need that because they burn through so much money just all for eternity. Like they lose over 100 mil a quarter, and sadly they just done it for all eternity. 300 mil a quarter, and they can never get really closer to profitability. So Snapchat, you know, I'd rather buy like an Instagram via Meta. Meta's way cheaper. Meta's significantly cheaper, you know, because they're at a forward PE loss. So if I had to pick one, you know, I wouldn't. That's the interesting thing, though, is because they made people pay. They're making everyone pay now, so maybe that'll bring them a lot of revenue. Who knows? Who knows? I just want to own it for a few hours and done. But yeah, hey, Eric, that's probably the right move. You want to kind of swing trade that sucker. Frosse said, can you do Bristol Myers? Yeah, that's that. Give me that ticker symbol. We'll check it out if you're still here, Frosse. I know they're like, could you look at SFRM, please? Okay, what's S? I typed up SFRM, Ethan. And unfortunately, that stock just doesn't exist, apparently. SFRM. Yeah, I typed it in right. Maybe you mean Sprouts Farmers Market? Ito said Poet. What is this one? Poet. Poet Technologies, another small one. You know, they're only worth 850 million. So that's a small market cap, 850 million. They're the same price as they were back in 2022. But let's see their most recent quarter. So they barely have any revenue, but they just basically got their first ever sort of revenue. The sales went from 3,000 to 300,000, which still isn't much. I guess that's why they're worth 800 million, but let's see. So they have 300K of sales. They're losing 7 mil a quarter, which is actually, and they're losing like 8% of the whole market cap a quarter. And so, yep, that's so sad. They've been diluting you by 25, 30 mil a quarter. So I bet the shares outstanding are just rocketing up higher. But the stock has done great. Like it had a good little gap up on this day. There was no earnings or anything this day, but there was some good momentum there. They gapped up. As long as I guess keep up this sales growth, I guess analysts are expecting next quarter 500K of sales. You know, you annualize that's 2 mil. But, you know, this is just like, you just can't really trust money in this name. Hey, there's your CEO there. Poet is powering the age of photonics with innovative products. Multiple award. Okay. Anyway, yeah, I'd keep the allocation very low to that one. Lexin FinTech LX. Oh, we found it. Let's check it out. Um, Braze. Hey, what up, 6 star? We'll check out Lunar too. Yeah, hey, if y'all enjoying, make sure to hit the like button. We stream every Sunday this exact same time. We're gonna be live for another 40 minutes. So here's Lexin FinTech, and I saw nothing. Yeah, watch out for people impersonating me. Yeah, I just saw someone say, "Did you just DM me?" And that was actually not me. Please watch out for people impersonating me. I'll never follow you or DM you. I don't sell anything. No course, book, Discord. I don't coach. Literally sell nothing. So let's check this out. Lexin FinTech is at a super cheap valuation. I kid you not. They are trading at 2 times next year's net income. Where are they headquartered? Oh, China. That might make a little more sense. So all the revenue comes from China. Are they also headquartered in China? Yeah. So they're also headquartered in China. Oh, so we'll convert the currency from China, or Chinese yuan to USD. So the revenue declined year over year, but this isn't USD. That's actually a lot of revenue. They did 480 million in revenue, but it did fall 8% year over year. So revenue's down 8%, but the net income, whoa, or actually, well, that must be from interest or something. The profits fell by 11, but they're still making good money. 60 mil, 70 mil of net income every quarter. So, yeah, they don't. That made that the valuation really is a 2. They really are trading at 2 times PE. Yeah, that chart doesn't look too great right there. And it looks like the growth is going away. Oh, wow. You get a 9.4% dividend. And for that 9% dividend, the payout ratio is only a 15%. So, yeah, whenever you have a low PE ratio like that, it's kind of like a Crocs, where they have like a 17% free cash flow yield because the PE ratio is so low. So you basically like instantly get paid to own that. But there's the long-term chart on that did look a little concerning. So here's Braze right here. I don't know what this company is. I feel like I've heard of them. They're worth $3.7 billion. Did they there is no earnings, or yeah, there's no AI covering the earnings. So let's see. Customer engagement platform. Let's see what their earnings were. That's the orange line. So they beat on revenue. Analysts expected 184. They did 190. They did miss on their EPS, and they did beat on their EBITDA. So it was overall good quarter, but I can kind of see why the stock is the same price that it was in 2021. Let's see, revenue right here. Actually, this is good. Sales are up 25, after it grew 22, after it grew 33, after it grew 45. So nice little top line growth. Are they profitable yet? So they're not profitable. They're still losing 30 mil. Looks like the losses are worsening. They lost 30% more net income than the previous year. So we do kind of want to see their losses narrow, because normally that happens as the revenue grows, but maybe they're just investing a lot into the future, which is kind of, yeah, dang, invested 160 mil or, Anyway, Braze is interesting. They've been beating on the top line. They've just been missing on their net income numbers. They're losing a lot of money. That's the only thing that sucks. They lose a lot of money. Yeah. Um. Okay, let's see here. Nate, I'm telling you, IDEX. Oh, yeah, hey. Oh, BMY. Yeah, Bristol Myers Squibb right here. They sell like a bunch of different prescriptions, I believe. Bristol Myers, though, do beware. This stock is the same price that it was in 1998. So you bought Bristol Myers Squibb in 1998. It's the exact same stock price today. But they sell a bunch of different prescriptions right here, like Eliquis, Opdivo. Let's see how they're growing. So most of their business, 30% of it is this prescription. That's up 24% year over year. That's good. Opdivo is up 7% year over year. Orcancia is up 2.9, 15. That one's down 24. So let me actually see, is there any, there's probably AI coverage on this name. Let's see what they have to say. So portfolio revenue increased 18% to 6.9 billion, led by Eliquis and Opdivo. Legacy portfolio revenue declined 12% due to generic competition impacting prescriptions like Revlimid. Operating cash flow rose 12%. So hey, it's like mixed bag here. So 70% of the revenue comes from the US. And overall, if you kind of average out the 4 quarters, they're making, and this was a little one-time adjustment, I'm assuming, they're making like 1.6 billion of net income every quarter. They do pay a dividend too. Yeah, wow, a 4.8% dividend. So let's say they're making 1.3 billion of net income a quarter. The dividend cost, so 1.26 billion, a bit of a high payout ratio, around an 80% payout ratio from my math. Um, so honestly, interesting name there. I pr- maybe like Eli Lilly's growing a lot more. They've had some, yeah, they've had a disappointing stock price, but you get a nice yield. It's kind of reminds me like a Pfizer. Pfizer's also, it's not just, Bristol Myers Squibb. Pfizer's also the same price that it was in 1997. And they kind of have like a higher yield too, a 6.6% dividend. Um, Meta or Google or Amazon for long run. The truth is, you want to own all those. What up, Big Brendan? OLP Papa, dude, thanks for that gift there, OLP Papa. I appreciate that. Good to see you. Happy Sunday. But yeah, I own Meta, Google, and Amazon. Those are all three stocks I think are worth diamond handing and never selling. So it's hard to just pick one. They're all at fair valuations too. Even like if you have the intention to never sell these names, just like me, it's worth buying at today's prices. Amazon's at a 29. Meta's at a 22, Google's at like a 29. Like if these are bubbly valuation territory, like this can't be peak bubble, I don't think. Like we're nowhere near peak bubble if these are the valuations. Like Nvidia's at like 28 forward PE. Like I think like there's so much future like runway to the end of the decade. We just keep on rallying. But I don't want to be over kind of bullish here. But yeah, let's see. Lunar, what up? Have fun. So Lunar, this is a stock I don't really love, but they have been getting a lot of launch contracts to the moon and stuff. Like I remember watching this a long time ago. They sent a little rover to the moon, but when it landed on the moon, it tipped over and like broke and didn't collect any data. And the stock tanked 50% preceding that. But now I think they've gotten some more contracts. Let's see what the revenue is. I know it's going to look a little choppy. Or actually, no, it looks good. It's actually like 50 mil a quarter. Did fall 10% year over year, but that's not too bad. They are losing, that's not even that much money, 15 to 30 mil in net income a quarter. They're just not my favorite space stock. I'd probably like Archie Aviation a little more. Low altitude economy. Wonder if we can see like that whole stocks all in that industry. I like how they have the breakdown, but yeah, anyway, that's Lunar. I'd be so careful with that one. Rubric RBR. Did you see SoFi taking a holiday? Oh, hey, let's actually check out SoFi too after this. I am a SoFi shareholder. I want to see them do good. So here's Rubric right here. This is your cybersecurity play that just has phenomenal growth, like insane top line growth. And part of it's from an acquisition, but here's why they deserve such an expensive valuation. I do think cybersecurity is like a part of software that's like immune to AI. Like hackers will utilize AI and get better at hacking. And cybersecurity, I think, is just always going to be needed. And check out their what they're reporting versus what the analysts expect. That's that orange line there. Massive beat. They expected 320. They did 350. Every quarter, there's a massive beat on revenue. Sales are up 48%. After grew 42. And that's when they IPO'd. So part of that, though, if we go to the cash from investing activities, they bought a company for basically $900 million. The cash flow is insane. Triple-digit growth every quarter for the past 4 quarters on their free cash flow. Yeah, insane. So just a pure growth cybersecurity name that's just not profitable yet. It's scary. I wouldn't have it as a big position because those huge net income losses, but they have that top-line growth that's just like so impressive. So impressive. So let me go over SoFi real quick. SoFi, yeah, waiting on Artemis 3 moon mission next year. We're going back. Hey, we're going back to the moon. Hey, nice there, Have. So here's SoFi Technologies right here. This is a fintech. I do own them, by the way, full disclosure. I was so stupid. I regret every share I've ever sold of SoFi. Kind of same with Robinhood too. Like we had 50 shares, we sold 50 shares of them at $36 for a 3x, and now it's 130. So anyway, here's SoFi though. Another one I had sold a bunch of. I'll never sell the remainder of my shares. That's kind of like my promise. And I might even try and buy more. But SoFi, it's tough to buy now. It deserves a high multiple, but it's tough to pay this. Like 48 forward PE on SoFi. And check this out right here. Here's the reason they deserve a high multiple. Check out their financial services specifically. This is crazy. It's up 76% year over year. After grew 101, after grew 140, after grew 290. Like I can't believe the growth there. Like on an annual basis in 2020, the full year, the revenue was 11 million on this sector. Now it's 820 million for that full year. And just this quarter, it's 420 million. Like at this 100% growth rate, what's it going to be the same time next year? So that beats all analyst expectations. Check this out. The orange lines, what the analysts expect. Every quarter they beat on revenue, they beat on EPS, which is net income, and they beat on EBITDA. So I think no wonder people are starting to take SoFi seriously now. They're almost at their first ever $1 billion revenue quarter. They're making 100 million net income a quarter, growing like crazy. So I am a shareholder, so I'm totally biased, but I do really like SoFi. Don't love its current valuation though. Would you invest in Berkshire Hathaway? I would. I do think Berkshire Hathaway is like a great alternative to like the S&P 500. So this is basically Warren Buffett's alternative to the S&P 500. His portfolio, it's kept up, I think, if not slightly, has outperformed the S&P 500 every year in the long run. So they wholly own some businesses, and they also own a bunch of stakes in companies. But look at this, like insurance, they fully own Geico. If anyone's heard of Geico before, they fully own them. They're in manufacturing like McLane. They own Pilot. If anyone's heard of like the Pilot gas stations, it's kind of interesting diversification there. They own like Dairy Queen and Energizer. Anyway, but look at this right here. They print net income every quarter. They don't do dividends. That's what I like about them. They don't do dividends because they do it all in share buybacks and buying new companies. And we can actually see the most recent moves in Berkshire Hathaway. So if we go right here to, the Berkshire Hathaway portfolio right here, their newest position, I couldn't believe this. They actually bought Google. It's a great never sell name. This is the most recent quarter. That's their only new position this quarter. They bought Google. They decreased their position in Apple. Like people are freaking out. Berkshire Hathaway sold 42 million of Apple shares. Well, even after that decline, it's still 20.6% of their portfolio. So it's like no big deal. Anyway, yeah, here's the whole portfolio. American Express. These are the publicly traded stocks they own a little bit of stake in. So anyway, yeah, Berkshire Hathaway is really cool. Great kind of S&P 500 alternative. EOSE. Oh, wait. Hey, what up? I see a new person in here. What's up? BKR. Yo, if anyone wants to hit the follow button, we actually stream every single day. And every Sunday, this exact same time, every single Sunday. We're also going to be streaming at 8 p.m. tonight. So in exactly 7 hours and 30 minutes, we're also going to be live when the market opens. Yeah, and watch out for people impersonating me. I sell nothing. I have no course book. I don't coach. I literally sell nothing. So anyway, here's Baker Hughes. The PE ratio is an 18. So they're trading at 18 PE. Who are the shareholders? So, okay, is this like a real estate developer or what does this company do? No, provision of oil field products. That's interesting. Let me check out their website right here. Making wells predictable, productive, and profitable. Learn what we do. Well, I do, but I don't know if I want to take the time and read it. Anyway, let's see what their actual numbers are. So maybe they're a bit exposed to like the price of oil, that commodity, but let's go look at their numbers. So yeah, oil field service and equipment. That did fall 8.3% year over year, but maybe that's just because the price of oil. Then they're in the industrial and energy technology. That actually grew 15% year over year. After grew 10%, after grew 36%. So they're continuing that streak there. Yeah, so maybe that's why they're doing so great. Like even though the revenue fell 8% year over year, that actually beat expectations. The analysts expected 6.8, they did 7. So they beat nicely, and they're making a lot of net income every quarter. 600 mil. Net income a quarter. Looks like they had a little one-time adjustment there. But yeah, 600 million net income a quarter. What's the yield? A 1.92% yield, a very safe payout ratio. They raise a dividend every year. So that's actually interesting, like oil stock. Baker Hughes. Let me put them on the watch list. Just, yo, Tommy, what up, man? What do you think of an HSA account? Is that like for, is that for Canadians? I have a Roth IRA. There's also like the self-directed IRA. But yeah, is that a tax-free retirement account? I'm always a fan of the tax-free retirement accounts. What brokerage is this? Yeah, hey, if you want to get this brokerage, I'm on Life. It's in the link tree in my bio. Very first link there. My favorite brokerage to buy stocks on, analyze stocks on. It's an affiliate link too, full disclosure. So if you go and like deposit $100, you'll both get like some free stocks, I think. So hey, no way, Puck, with all those roses there. No way. I really do appreciate that. No way. How do you understand if a company do share buybacks? Watching the financials, I'm not able to. Well, here, there's a huge buyback example. Let's do PayPal right here. Hey, what's up, Brandon? So unfortunately, PayPal stock is the same price that it was in 2017. So PayPal's done terrible. But here's one thing I really like about PayPal that they're doing is share buybacks. And here's just a quick way you can tell if a company does share buybacks. You go to the cash flow statement and you scroll down to the cash flow statement, and it's always in here, is the net common stock issuance. And if it's negative, that means they're buying back their own stock. If it's positive, that means they're diluting you. But here's what I love about PayPal. For the past 4 quarters, they're buying back 1.5 billion of their stock every quarter. And here's another way you can tell if a company does buybacks. You look at the net income growth rate versus the EPS growth rate. So check this out. The net income is up by 23.5, but the net income per share is up more than that. It's up by 32 because the share part of the ratio went down so much. Again, the EPS growth rate and the net income growth rate should always look the exact same. The only thing that changes that is the share part of the ratio. And again, whenever they do share buybacks, makes the EPS go higher, which makes the PE ratio go lower, makes the dividend cost less, and gives you more ownership. So in short, it just forces the stock to go up. So yeah, PayPal trades it at 12 PE. They're doing the right thing, buying back their own stock at this price. Adobe's doing massive share buybacks. What was that roofing repair company earlier? Apologies, I was driving but listening. Yeah, hey, that was Carlisle Group, CSL. I own a lot of this stock actually. That ticker symbol CSL, Carlisle Group. They own Henry. If you've heard of Henry before, one of the best-selling like brands at Home Depot and Lowe's, but 25% of the business is exposed to residential. But I like that the other 75% is commercial and industrial. Like even in a recession, people always got to fix and repair their roof. You can't let that roof leak; it'll cost more and more damage. So and actually, they benefit from like storms and stuff. But anyway, healthcare spending account. Oh, the HSA. Oh, thanks for that, Chief Cliff. I appreciate that. That's pretty cool about the HSA. Health spending account. Okay. That's cool. Tax-free health insurance spending. Then you get a check at the end of the year or reinvest. That's cool. It sounds weird, but I heard positive things about BlackBerry. Any thoughts? Hey, thanks again, Puck, for all those gifts there. Let's do it. And Life Wonders. Hey, Life, remind me to get to ExxonMobil. Dude, thanks for those gifts there. I'm a little behind here. I see ICIC and I see a lot of stocks I got to get to. I do apologize. We're going to be live for another 30 minutes. Don't worry. So here's BlackBerry right here. They're a small company. They're worth $2.5 billion. Is there any like news around this company? BlackBerry to release Q3 earnings December 18th. So they report earnings. Wait, that's in 4 days. So this week we get BlackBerry earnings. So if you buy them now, you're basically buying them, betting on earnings. But yeah, they obviously sold phones a long time ago. In the year 2000, this stock was $125. Obviously, they lost the smartphone battle. So BlackBerry's at $4 a share now. But they're like changing their business model. They're no longer like a phone company. Boy, BlackBerry is forecasted to achieve strong growth driven by the QNX automotive software dominance. Automotive software company now. Secure communications, government contracts. That's cool. Leadership. Okay, let's go look at their actual numbers here. So QNX, secure communications. So their secure communications business, do beware, that's down 9.9%. After fell 15, after fell 28. So that might be like a slow bleed. What about their QNX? This is the company I think they just acquired. Or let's see how much they spent on that acquisition. If you go to the customer investing activities, well, actually, no. Revenue is up 2.6 after fell 4. But they did go net income positive. They barely made some net income this quarter. Nothing's really blowing me away here. Guess we'll see how that acquisition grows. North America is only 46% of the revenue. They have been beating on expectations though. Like look at that. They beat on revenue, they beat on EPS, they beat on EBITDA, but they still haven't done too great. Anyway, I wonder, I think it might have been Nokia. Nokia is the stock that NVIDIA is taking a stake in. Oh, this is headquartered in Canada. So Canadian name there. They're moving into government contracts heavily. Oh, yeah, we saw that on the AI thing. Yeah, see, government contracts might be the move there. So, yeah, in 4 days, wait for those earnings. It might be, what was the forward PE on BlackBerry? Let's see. They might not have one because they do actually. So, the forward PE is a 33. So, they're trading at 33 times just next year's net income. And that might even be cheap because they basically are just now getting profitable. Balance sheet look good too. Maybe it's worth a small little amount of money. Kind of liking Nokia a little more. Yeah, hey, what's up, OLP? You mean Harvey Windows? Thank you. Also go to your YouTube page. Hey, thanks so much, JC. Yo, if you want to know the best way to support me is just subscribe to my YouTube channel. No way, dude. S. Lopez is in here. And S. Lopez says, um, happy Sunday. I'm a certified Carlisle roof contractor. I love their products. Yo, that Carlisle has the best like labor saving roofing products, like these TPO sheets that go over the roof. And like I think they're called Rhino Shield or like Rhino. Basically, like install the roof by just implying these little things. Anyway, Carlisle is such a cool roofing company, and actually, I decided to buy their stock, and I've been holding the stock for a long time. Cool thing about Carlisle Group, they've been raising their dividends for over 49 years. Never had to cut it once, not during 2020 or 2008, because even in a recession, people still get their roofs repaired. And oh yeah, look, I did a little fractional share buy. I never mind buying fractional shares of stocks. It doesn't scare me. So I bought a zero point 0.1 shares, but we just get nice dividends from this company. They've raised it every year. So yeah, we've owned them for almost 2 years now, Carlisle Group. And I've owned them for 2 years and we're down 0.26%. So the company has underperformed the past year, but I still love them. I think their sell-off is overblown. Speaking of Amphenol and this other stock, another stock I bought on the dip was Amphenol, ticker symbol APH on Friday there. We bought one share at 129. All right. Let's see here. ICICI? We found that one. Let me know. Are you talking about IBN Bank? He said ICI. It must be this stock. I know the banks have been doing very well, and this one has. I've never heard of this bank, but they've done phenomenal. Pretty much all-time high. Where are they headquartered? Okay, so look at this. This looks like in India, or that's India or Indonesia. Wait, yeah, headquartered in India, and they're India's bank. Yeah, so retail bank, treasury, wholesale bank, and they're in life insurance, general insurance. So basically, you're all-in-one India kind of like fintech company insurance. Bank, the net income did fall 3% year over year. That might be why the stock is a little off all-time highs of $34, but what's the yield here? You get a 0.8% dividend yield. Valuation is a 17. That's actually expensive for a bank. JP Morgan trades lower than that. Yeah, look at that. 18 PE, industry average is a 13. But anyway, that's actually cool. If you wanted exposure to India, that might be a great way to. Synthetic roofing products by Carlisle. Yeah. And Carlisle's been the best part about Carlisle Group, and last thing about this stock, is the amount of share buybacks that they do. If we look at, honestly, I wish they did more acquisitions than share buybacks right now, but check this out. If we go to the total common shares outstanding on Carlisle Group, they've bought back 7.7% of the company after they bought back 7% of the company, after they bought back 2.9% of the company, after they bought back 1%, after they bought back 5%. So here's 2020 right here. In 2020, the total common shares that extended were 2020 Q2 was 54 million. So there were 54 million shares just in 2020. Now today, there's only 41 million, 41.9 million. So they're a share buyback monster. And that makes the cost of the dividend go down. They pay a dividend. It only costs $47 million a quarter. They can look at just this quarter was $420 million cash flow. The net income was $200 million. So the reason the sales have been flat, though, you notice how the sales are only 1%, 0.08 growth. It's because, part of that is because they sold off business. Actually, y'all are going to believe this. They sold their interconnect business for $2 billion to Amphenol, to ticker symbol APH right here. And that's actually how I found out about Amphenol stock, through them selling their business to Amphenol. And then I'm like, hey, they look great too. So let me buy them. Yeah, Amphenol is really interesting at their current multiple. Amphenol's at like what's their current PE? A 31 forward PE. That's fair in my opinion for a growthy behemoth as them. Eric, we looked at Rubrik like the first time you said that. I think if you scroll back a while, you should be able to find it like 10, 20 minutes or so. Are you adding Call Main? I'm actually, hey, what up, Mike? So I actually do own Call Main, but I'm not adding more to my position. I'm happy with my position currently. I got 5 shares. You wouldn't want this as a huge size position in your portfolio just because They're so exposed to commodity. This is your chicken egg stock. They have the number one market share for chicken eggs in the US. And so it's commodity related. But as we know, with inflation, the price of eggs has been nuts. There's also some conspiracies around like the bird flu and burning down of chicken egg facilities. So it's all that noise only benefits Calmain and gives them so much pricing power. Here's what's so cool. The whole company's worth $4.2 billion. That's what you're paying. That's the market cap. Valuation is $4.2 billion. They literally have $1.25 billion of cash on hand. So literally, basically 25% of what you're paying is just their cash on hand. So you can do an X cash PE multiple. So you're left with like a $3.6 billion company, and here's their net income. They are printing a couple $100 million net income, and that's real. Like that one quarter when they made $508 million, that was real. That's after they paid $130 million of taxes. Like it's insane the money this company makes, and because of that, they're rewarding you as a shareholder. They have a rule where they pay out 33% of all their EPS in terms of a dividend. So that's why the dividend changes every quarter. So, yeah, great commodity stock, and it's kind of like an oil play. You keep it as a small position because it's a bit exposed to commodities, but I like that one. BTC is in the process of a long bull run in 2026. Hey, I hope Bitcoin does good. I actually do not own any Bitcoin. I own the picks and shovels play of Bitcoin. Oh yeah, we were talking about Bitcoin. Bitcoin is like a triple beta NASDAQ, or it kind of rhymes together. So whenever the NASDAQ's up 1%, so anyway, we're comparing that. But Bitcoin's kind of like a catalyst-free asset. Like whenever like a stock, they have a quarterly earnings report, like they can miss on their net income and net margin, but not Bitcoin. Bitcoin doesn't report earnings, which is kind of cool. I actually kind of own the picks and shovels play, which is Webull stock, Robinhood stock, Futu stock, and SoFi. Basically, whenever you go buy crypto on one of these platforms, they collect a juicy commission. So hello, everyone. It's been a pleasure. Hey, what up, Moana? Or Mona, how's it going? Hope everyone's having a great Sunday. What indicator do you use? You're talking about like technical analysis indicators? I don't really use any. I've been using Amphenol fittings for decades. Hey, awesome, JC, supporting the stock. My one regret was not buying more Amphenol. And I don't even mind raising my cost basis. It's tough to like start a position out today. But in the long run, I just want more and more quantity of Amphenol shares. Everything there's, should I analyze them? Why no Coinbase? I actually do not own any Coinbase because I like the brokerages where you can buy. Actually, Coinbase just did this, which I think was genius. Coinbase, that's a Cathie Wood play. If we go to Cathie Wood's portfolio right here, she got Coinbase, Robinhood, but on Coinbase, here's Coinbase next to a Bitcoin. It's kind of like a Bitcoin proxy. It's not exact. It almost is close to exact, but they rhyme together, kind of like a pseudo Bitcoin play. I like Coinbase here. We can see right here their monthly transacting users is 9.3 million. Your monthly transacting users, not just monthly users, is 9.3 million, when this exact same time last year was 7.8 million. But one thing Coinbase did just add is the prediction market. So you don't just buy crypto on there. You actually I don't know if they've released it yet, but you can do prediction market stuff. And that's why if you look at old Robinhood stock, and I actually sold Robinhood stock when Bitcoin hit 100K, because Robinhood was doing just as well. Robinhood hit 100K, but Robinhood, ever since Bitcoin hit 100K, has continued to climb up because of their prediction market stuff and the Robinhood Gold. So I like that Coinbase is getting into the prediction market stuff, but here, let's see the revenue. Wow, revenue's up 55% year over year. They're making a good bit of net income. What's the forward PE on Coinbase? It's expensive, a 39 forward PE. Actually, their current PE is a 23. So the forward PE is a 40. So their net income's supposed to fall. Did they have some like one-time adjustment? Let's see. So here's how you tell. The net income was 430 million. Oh, it was last quarter. Look at that last quarter. It says they made 1.4 billion in net income last quarter. They didn't actually. Whoa, the core business actually lost money last quarter. Anyway. Cathie Wood play though. What app is this? Hey Rando, if you want to get this app I'm on, it's in the link tree in my bio. Very first link there. My favorite brokerage. It's brokerage where you buy stocks on. It's an affiliate link to full disclosure. So if you go and like deposit $100, so both get like some free stocks. But cool. Lowest fee brokerage, costs nothing. And a lot of people like the APY casher here. If you look at the middle of my screen, you get like a 3.35% APY on your cash. Or you can just type it into Google, broker called Moomoo. You don't got to use my link. Have you ever compared your picks to the S&P 500? Have you beat it? Yeah, well, actually, we have 3 different portfolios here. I love being fully transparent. I'll be quick about this. We'll get to the next stock here. But yeah, this is our Moomoo portfolio year to date, and on a return money weighted average, the metric you want to use. We're up 81% year to date. We were doing just as bad during that tariff dip. We were down 16%. NASDAQ was was down, or S&P was down 15, but now we're up 81% year to date. How are we up so much? It's because we bought the dip, and we didn't sell out of it. Like during this April dip, we bought, this is mainly from Comfort Systems. We bought $4,000 of the stock, and now it's worth $7,200 more, literally just since April. And same with a lot of these other names. We bought the dip on Coke. Like, we bought all these stocks literally this year. It's been such an anomaly of a year. Like Powell Industries, well, we bought that one a long time ago. Amphenol, we bought the one during the April dip. Amazon, we've been dollar cost average. Like, those are all my buy orders. So that's where all those little B's are. Those are my buy orders. So I just dollar cost average into a lot of these names. Same with Ferrari. I've been slowly buying from Ferrari. In this environment, though, you got to be careful. And that's that portfolio. Here's our Robinhood portfolio year to date, or we're up 15% year to date in that portfolio. Like, here's our Webull account. Here's our all-time performance. See, we're only up 19.5% all-time in here. So anyway, if you got any more questions, let me know. I also do a bunch of stock portfolio updates on my YouTube channel. And of course, none of this is financial advice. Please be careful. Don't listen to me. Always go do your own research. I sell nothing. I have no course book. What app is that? Or I just went over a bunch of apps here. By the way, these are all brokerages where you buy stocks. And if you're interested in buying stocks, these are all my favorite brokerages. So if you want to get any of them, they're all in the link tree in my bio. Full disclosure, they're all affiliate links. If I had to pick one, if you're new, I would get this one right here. It's the very first link in the link tree in my bio. No fees, no commissions, cost nothing. Nice little APY on your idle cash. And this is the best app to do analysis on. Like, Robinhood is great. It's super simple, so easy to use. Actually, they make you pay $5 a month to get the 3.5% APY, but you get this one called no monthly fees, no nothing, and you get the APY. Anyway, let's go look at some more. Have you ever used the robo-advising? No, I haven't, but I have seen that before. Rivian, Rivian, I sadly don't like this one because they lose too much money. But one cool little event here, if we go to the AI news here, they unleashed their own chip. Rivian unveils AI chip. Like, Rivian, the car company, is getting into chips? No freaking way. But yeah, they were expressing the cost and performance and the benefits of the in-house chip development, they were saying, like LiDAR sensors. So anyway, they make these electrical vehicles. Their largest basically customer is Amazon. These are so cool. Has anyone seen those Amazon electric vehicle trucks? They're beautiful. But sadly, this isn't a good business model. I don't think they're burning through a lot of money. A billion, 500 mil, 700 mil, and so they're losing billions a quarter. And let's say they get profitable. Like, the end game goal is like, it'll be like a single digit margin business, kind of like a Ford or maybe even, I guess if their software revenue does good, but it's a tough, like, it's such a competitive low margin business, and it's so expensive. But they make these electric vehicles. I love the Amazon partnership. And actually, this is like a robotics, almost like manufacturing play for Amazon to acquire in the future. Amazon has had to write off so much from its initial IPO valuation. Actually I bought and sold Rivian the day it IPO'd. And I still can't believe it. Actually, not if no one cares. Wow, this was $179. See, look, there's the buy order. We bought this. I haven't bought an IPO since, but anyway, it was $103 a share. Okay, let's look here. Oh, hey, yo, way! Shout out to the member Brian on the YouTube stream. He said ORN Orion Group. Let's check this stock out right here. Oh, and QXO. Hey, 6-star. QXO is that other roof building play, but on that stock, it doesn't have the numbers yet. But maybe we'll check it out. So here's Orion Group. I've actually not heard of this stock before. Let's go see what they do. Marine and concrete. Let me actually go check out their website. Is that like actual, like, building, industrial, and infrastructure sectors. Let's see. Construction, discoverable, Orion Concrete. So it's a concrete company, maybe with the prioritizing on time and on budget performance with safety always approach. Interesting there. Oh, so they pave sidewalks. Okay, so they pave sidewalks, elevated beams, ramps, tilted walls. So let's go see what their net margin is for this company. So yeah, it's usually a negative net margin, but sometimes they have been getting some low single digit net margin business. So yeah, it's probably, the net income's just low here, 3 mil, 800K. So a bit of a choppy net income. The sales did decline. It's only 0.7%. So this is a concrete play. Oh, dude, there's a limestone play I love. There's no way. It's like LMSN. There's no way I'm going to find it. Is it LSMN? There's no way. Let me see if I can find the ticker. It's like a uh, it doesn't matter. Anyway, I'd be careful. Oh, it's USLM. We found it. USLM. We looked it up. This is a really cool stock if you're looking for kind of like a, I guess, somewhat competitor. I've actually considered buying this stock. And even look in 2019. In 2019, this was a $20 stock. Now it's 120. Here's why they deserve that and might go higher here. Let's see. The current PE is a 28. Or yeah, they're trading at 28 times PE. All they do is sell lime and limestone. It's crazy. The revenue for the first time ever was over 100 million of revenue, and they actually have a surprisingly good margin. Check this out: 38% net margin on selling freaking limestone. So they made 38 mil, 30 mil, 30 mil. At this growth rate, what's it going to be the same time next year? Now it is a commodity stock. They're selling limestone, but what takes a lot of risk off the table is a fortress balance sheet like this, where they have no debt whatsoever and a lot of cash. $350 million of cash, no debt. What's the market cap? Whoa, so basically 10% of the entire market cap is just their cash on hand. They're worth 3.7 billion, 28 PE. It's really when you do an X cash PE, they're trading at 25, 24 times PE. They deserve this stock price appreciation. I can't believe 40% net margins on frickin' limestone. There you go. And they pay a dividend. I think they're doing dividends and share buybacks. I kid you not. So yeah, look at this, a 0.18% dividend. Yeah, it's a super low yield, but super low payout ratio, and they raise it every year faster than inflation. I don't know why I like this stock so much, but yeah. Anyway, there's USLM for you. Hopefully that was a cool little new stock I could introduce you to. So someone said, or 15 said RDY. Oh, and I got to go in 10 minutes. But here's Dr. Reddy's Laboratories. Wow, Dr. Reddy's. I haven't heard of this guy before, but they're a big company. They're worth 11.6 billion. The current valuation is an 18, but the forward PE is a 21. So that means their net income is supposed to fall 20%. That might be why the stock has been flat for a couple years. So it's another India company. So we'll convert the currency from India to USD. So do beware of that. Global generic. So maybe they select generic prescriptions. I wonder how the margins on that are. Let's actually go see what their net margin is. 16% net margin. That's good. Ooh, but that's down 22%. Yeah, it looks like they used to have a closer to 20% net margin. This quarter, though, they beat on revenue. They missed on their EBITDA expectation. I don't know. They're still making good net income every quarter. They're still making 160 million net income a quarter. But the sad part is it might still be a little expensive. Or 21 PE. I don't know. You kind of just... They did beat expectations this quarter, which is interesting. So QXO, I don't think they acquired this roofing company. Before this, they were like a blank check holdings company. And basically, here's what I mean here. Look at this before today. The assets, was their cash, and then they acquired this company. So that's why the balance sheet changed so dramatically. So yeah, look at the sales. Well, of course, so yeah, no sales before today, 13 mil, but after the acquisition, 2.7 billion of revenue this quarter. And it looks like they did probably acquisition related costs. They're losing money on that, but the operating profit says they did make money this quarter. So that's good news. Yeah, cash flow was 200 mil. So residential roofing products, that's like a Carlisle Group, non-residential roofing products. What's their website right here? Will it show us like their, we tried their website before, it didn't work. Anyway, some sort of building products roofing company. Interesting name there. Alberto said ONDS, please. Yeah, this is another, I think, LiDAR kit company, or maybe it's a battery company, or let me double check here. So yeah, Ondas Autonomous Systems. So what are they reporting? So yeah, there's a lot of future growth expected. Still a very small company. I wouldn't really trust a lot of money in, but the revenue is going to go from 4 million to 17 million year over year. Literally, it was 10 million this quarter, a record. They beat expectations. Analysts expected 7 and they did 10. Next quarter, they're expected to be 15. And usually they beat on it. So if you kind of annualize that number, they're going to be doing like 60 mil of revenue a year, which is a huge increase from, basically no sales to 60 mil a year, which is crazy. Dang, they just fortified their balance sheet. Was that from dilution? Let's see. Yeah, so they diluted you by 400 mil. What's the market cap? So they diluted you by over 10% of all the shares that exist, but it fortified their balance sheet because they're losing money, right? So they're losing 7-10 mil a quarter, but they have 450 mil of cash and no debt now. So look at that. So they used to be really leveraged, 67% liability ratio. Now it's a 7. Whoa, that's crazy. So Ondas Holdings invest in Ukrainian drone firm, secures government drone contract. That's pretty cool. Um, Financials are not disclosed. Okay. Secures key contracts. A border protection system and an $8.2 million drone order at the European airport. So a European airport just did an $8.2 million order. Interesting name there. Maybe they're a drone company. I don't know. Just looks like they're finally experiencing some real growth and real revenue. I'd still be so careful with them, but I do like their net cash position. Can you check out Mercati Libre? Isn't that like e-commerce company? Is it MELI? Yeah, here we go. We found it. This is basically I think South Asia. Let me see here. Or no, this is your South American, basically Mexico, uh, e-commerce Amazon. So Brazil is 55% of the revenue. Mexico is 22%. And what do? They're in commerce services, financial services, credit revenues, kind of like a fintech too. They're making great net income, easily 400 to 600 mil in net income a quarter, after they pay, like 200 mil of taxes a quarter. Sales are up 39 after grew 35. I love the top line growth. I love that they're making net income every quarter, but the forward PE is a 41. That's an expensive valuation, 41. That makes Amazon look like a steal. I'd honestly, sadly, probably rather buy an Amazon on the dip. And I do own Amazon, so I'm totally biased when I say that. But yeah, Amazon is actually at a 29 forward PE. That's why I don't think we're in such a bubble as some people think. Like valuations are fair. Well, on most names, like the Mag 7, except Tesla. But yeah. All right, we'll look at one more here. Taco says, "What's good? You're the man." Hey, what's up, man? Hey, we've been shooting for 2 hours and 30 minutes. I do got to go in 2-3 minutes here. But yo, if you guys wanted to follow button, we're actually going to be live at 8 p.m. tonight, or in exactly 6 hours from now. Exactly 6 hours. So if you wanted to follow button, we'll be streaming for another 2 to 3 hours then. So yeah, by the way, I saw nothing. Why I sell nothing, no course book. Please watch out for people impersonating me. So yeah, here's back to RBRK here. This is actually a cybersecurity name. I do like cybersecurity because I think it's like an industry that's immune from the AI kind of bubble because, as AI gets better, hackers will utilize AI and, the need for cybersecurity will always be here, I think. You look at Adobe, Salesforce, those are some of the AI, some of the software names getting hurt by AI. But check this out. Rubrik just beats on every expectation every quarter. Check this out. They expected 320 million of revenue this quarter. That's the orange line, what the analysts expected. And they reported 350. Every quarter, they're beating massively on expectations. They're beating on revenue, beating on EPS as well. So this is one thing I don't like. They lose 60 to 100 million of net income a quarter, but they're losing less net income than the analysts expect. So pretty cool. That's probably why they gapped up so much on earnings. Like, no wonder the stock gapped up so much on earnings day. I mean, obviously it's down on Friday because the whole AI thing, but look at this. I mean, massive beat on revenue, EPS, and on EBITDA. Whoa, the EBIT specifically, the earnings before interest and taxes, they're expecting them to lose 42 million. They made 10 million. That was a great quarter for them. And they bought a company. If you go to the cash from investing activities, you want this to be negative. If this is positive, that means they're actively selling out of their own assets. But they spent basically $800 million acquiring a company as well, which is leading more to the top line growth. 48% revenue growth after 42. So very nice cybersecurity company here. So yeah. Let me end this off with a quick portfolio update right here. So this is our Moomoo account where once we buy a stock in here, I never sell it. We kind of just diamond hand everything in here. And these are all the stocks that we own in here. We're up on every stock except for Ferrari down there. We are down a little bit on them. But yeah, we have a Webull portfolio as well. We don't really have any specific rules here. I kind of just do whatever I want. Our open profit and loss, we're only up 19.5% all time in here. We got some really good winners and some really big losers, and a lot of losers that, you can't even see on here. Like I had a charge point that I lost like 2K on. So yeah, we got some losers and some winners in here though. And some of my biggest regrets have actually been selling out of great companies, like selling out of Robinhood, selling Robinhood, trimming Robinhood. And so yeah, then we have our Robinhood portfolio. This is known as our dividend-only account, where every stock in here pays a dividend. Friday was rough. McDonald's was our only green name. McDonald's is such a fascinating company. It's recession. it does good in a recession. Historically, the sales go up in a recession. They acquire a bunch of cheap land in a recession, and they're not even a restaurant company. McDonald's is actually a real estate royalty company. You go spend $100 at any McDonald's, $4 of it go back to the parent company as a royalty, sales and marketing royalty, because all the franchises benefit from all the advertising the corporation does. And also, they own the land under 80% of all the stores, so every franchise is also a tenant paying back rent, which is so fascinating. So anyway, McDonald's is pretty much at an all-time high. We got a dividend coming in from there. But yeah, these are all my dividend stocks in here. Here's my total percent change. Luckily, we're up on every stock except for Carlyle Group. We are down slightly on them. And we have a Roth IRA. We only fell 0.04% on Friday. How did that do? Oh, yeah, our healthcare name kind of kept us afloat there. So yeah, that was the portfolio update. If you guys wanted to follow button, we'll be streaming exactly in 6 hours from now at 8 p.m. Eastern time. We stream every day, every Sunday, this exact same time. We do 2 streams on Sunday every day. And if you want to support me, there's only one way to support me. I sell nothing. I have no course book, coaching. I sell nothing. The only way to support me is subscribe to my YouTube channel. I'm trying to build up my YouTube channel and my subscribers on there. And I'm streaming on there as well. So if you missed anything, you can like rewind the stream when it's over and if you leave a comment when the stream's over too, like, hey, look at this stock at the very beginning of your next stream. Like, I can do that too. But anyway, have a great rest of your day. Thanks to everyone on the YouTube and the TikTok stream. Hope you have a great rest of your day. See you soon. And thanks to everyone on the YouTube stream. Vicious. Oh, man, I'm so sorry I missed your stock there, Vicious. REMX. You know what? We'll check that one out on the next stream. My apologies there. Thank you, everyone. 6-star, Marcus, Eric, 1508, the members, Brian, Paul, Looney. Thank you to everyone.